We are happy to have Kamal Gargji with us. And before we start, let's start our session with our protocol of having the ICA motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you everyone. Friends, today we have a very special session of 3 hours where we will be speaking on the practical intricacies. What is practically difficulties or practical aspects of two important aspects of India's. Number one, financial instrument. We say that if a person knows financial instrument incomplete, he or she knows most of the part of India's, because until and unless you know financial instrument, you won't be able to do a basic balance sheet of any listed company without any transaction. You won't be able to know what is a financial asset, what is a financial liability, what is amortized cost, what are the business models, what are the cash flow aspects, a cash flow test. So, and secondly, whenever we do balance sheet, most of the in-days application happens because it's an associate, joint venture, or parent company of in-days applicable companies. And to discuss the two important aspects of India, that is financial instrument and consolidation, we have two speakers from Delhi and Bombay. Our first speaker is CA Kamal Gargji, who has various books authored in his name. He is a special invitee in Accounting Standard Board and regularly giving training on India's and IFRS. And our second speaker is CA Himanshu Kisnatwala, who is a past president of BCA's, co-opted member of ASB, directors in various companies, and a renowned speaker. So in this, people keep on saying, why in this? I would say it's the right time to get ready for in days, as future is when it will be applicable to all the small companies. When in days will be made applicable for all the small companies, or all the AS will be converted in line with in days, it is the right time we get updated. Secondly, if you are not doing an India's balance sheet, if you are doing income tax practice, if you are doing M&A, if you are doing GST, if you don't know India's, you won't be able to file 9C. You won't be able to do math calculation. You won't be able to do ICDS impacts. I was having a discussion with a senior income tax professional, and he asked me to just check the income tax computation because of India's, and I found that the client forgot to take the benefit of rent paid, and he has removed the depreciation on asset in use directly from depreciation, and he didn't give the impact of the uh, uh, interest on the uh, leasehold liability. So these are the basic aspects which of an India's a person should know if he is doing whatever practice. Secondly, if you're investing in any shares, whether it's a ITC or HUL, if you don't know India's, you won't know the future of the company and you won't be able to invest properly. So I feel India's is a 360-degree knowledge which is required by everyone. So I welcome C. Kamal Garg and Himanshu ji will be joining with us very soon. And I will request our member Bina Jajuria ji to formally introduce Kamal Garg ji. Bina ji.
Kamal Garg is a fellow member of ICA. He is also a partner there.
Bina ji, the audio is not there, so I'll take the privilege of introducing Kamal ji as well. Sorry for the technical glitch. Kamalji is a practicing chartered accountant and he's a
Vivekji, sorry to interrupt you. I believe we should start the deliberation. You
one
have
second,
already
Kamalji.
given the
One
introduction.
second, Kamalji. 1 second. Just a small introduction that he's a fellow member of the ICI and he has done his first class commerce from Din Dayal Upadhyay College. He is a expert on IND AS. He was a study material research group member of NISC ICI. He has been a review group member of FRB ICI and he has long list of membership. He has written books on NEFRA from IND AS, a ready reckoner, standards on audit, practical guide and guide on tax audit. So with this, friends, please welcome Kamalji at our forum of ACAE. And Kamalji, without wasting your further time, it's all over to you.
Thank you, Vivekji, and thank you all other members who are listening me. All the participants, I acknowledge the presence of all the participants who are listening me. Before I discuss my topic on financial instruments, which is given to me, I must say one thing. The financial instrument standards itself is a granth. All the standards on one hand and financial instruments on one hand. Before I go into financial instrument standards, without understand the calculation part, financial instruments could not be understood. Most of the professionals are of a misconception that in their balance sheet they don't have any financial instruments. If this is so, it is a pure misconception. For example, trade receivables, trade payables, loans receivables, loan payable by default are financial instruments. So what I will be doing, my agenda of discussion would be, because I am being given around 90 minutes of discussion, first of all, I will be discussing what are financial instruments. And with this very discussion, each one of you would be in a position to understand whether a given item is a financial instrument or not. Number one. Financial asset, financial liability, then the subclassifications, amortized cost, FVTPL, FVTOCI, and so on. Then we will solve two numerical problems. Once we will solve those numerical questions on Excel sheet, I will mail the Excel sheet to each one of you also. I will in fact mail to Vivekji. He may consider to circulate further. Those Excel sheets basically are the templates or workings. So you will understand how to do the workings. You can enlarge the templates, you can reduce the templates as you wish. After discussing those workings, I will be discussing the concept of ECL if time will be permitting me, that is expected credit loss, which popularly was known as bad and doubtful debts in past. So I will be muting my video and will be turning out my share screen for financial instruments. Vivekji, please confirm once my PPT is visible to you.
Sure.
Is my PPT visible, Vivekji?
Perfect. Perfect.
Okay. So let us have the discussion on financial instruments. See, the words financial instruments tell a lot of story. The first word is financial and second is the instrument. I will start with the word instruments. The word instrument signifies a contract. So the prime incidence of financial instrument discussion is contract. There must be a contract. Now, when there is a contract will be giving some rights and obligations. And whenever there are rights, they will be deemed as assets. Whenever there are obligations, they will be deemed as liabilities. That means whenever we say instruments, instrument is nothing but a contract. Whenever there is a contract, there are bound to be some rights and obligations. If there are rights, these are your assets. If these are the obligations, then these are the liabilities. Now, this other word is financial. Whenever a contract involves money factor, that will be giving it financial aspect, meaning thereby only those contracts which have financial aspect within their domain, within their caricature, they will be classified as financial instruments. This is a very layman understanding of what financial instruments could be. However, the standard IND AS 109 read with IND AS 32 and IND AS 107. Three standards are there. I repeat, three standards are there. IND AS 32, IND AS 107, and IND AS 109. If these all are put together, how they are defining financial instruments, just see very carefully. Financial instrument is a contract. See, the word contract is used. So financial instrument is a contract that give rise to a financial asset of one entity and financial liability or equity instrument of another entity. As a layman, what I'm trying to say, हम लोगों ने contract किया and that contract is resulting in financial asset for me and financial liability for you. तो मेरा asset जाहिर सी बात है आपकी liability. So एक ऐसा contract जिसकी वजह से एक पार्टी को फाइनेंशियल एसेट मिलने का हक बनता है और एक पार्टी के लिए फाइनेंशियल लायबिलिटी बनती है, वो हो जाएगा मेरा फाइनेंशियल इंस्ट्रूमेंट. जस्ट सी वंस अगेन, फाइनेंशियल इंस्ट्रूमेंट इज अ कॉन्ट्रैक्ट that give rise to financial asset of one entity and financial liability or equity instrument of another entity. Now, why we say equity instrument? Equity instrument means that there are certain contracts which can be settled in other than cash mode by issuing equity shares. So whenever any contract is being settled instead of in cash but in equity instruments, that will also be classified as financial instrument. एक बार फिर से देखिएगा, financial instrument के लिए कौन-कौन से parameters आ रहे हैं? There must be a contract. Number second, that contract must result in financial asset of one entity. Then number third, that contract must result in financial liability of other entity or equity instrument of another entity. Now there could be single contract or a chain of contractual rights and obligations. तो एक contract हो सकता है या बहुत सारे contracts भी हो सकते हैं, and that's why the second part says financial instrument could be chain of contractual rights or obligations. If it will ultimately lead to receipt or payment of cash or acquisition or issue of an equity instrument. तो सिंपल सी बात क्या याद रखनी है? सिंपल सी बात ये याद रखनी है कि फाइनेंशियल इंस्ट्रूमेंट एक कॉन्ट्रैक्ट है जिसकी वजह से एक पार्टी को फाइनेंशियल एसेट मिलने का राइट बनता है और दूसरी पार्टी को फाइनेंशियल लायबिलिटी या इक्विटी कैपिटल इश्यू करने का ऑब्लिगेशन बनता है. ये कॉन्ट्रैक्ट एक भी हो सकता है या चेन ऑफ कॉन्ट्रैक्ट में भी हो सकता है. Now when you see the definition of financial instrument, they are using financial asset and financial liability as different expressions. So we need to understand what is financial asset and financial liability. I will come back to these slides later on. Just see what is financial asset. So financial asset could be cash or equity instrument of another entity. So cash is always considered as financial asset. Financial asset also includes contractual right to receive cash or another financial asset from another entity or exchange financial assets or financial liabilities with another entity under the conditions that are potentially favorable to the entity. So just second point likha hua hai, exchange financial assets or financial liabilities. These are nothing but your derivative contracts like put option, call options, etc. अभी मैं आपको एग्जांपल दिखाऊंगा एक्सेल शीट के ऊपर तो और क्लैरिटी मिलेगी. फिलहाल हम डेफिनेशन फिर से देखते हैं. What is financial instrument? Financial instrument is a contract that results in financial asset of one entity and financial liability or equity instrument of another entity. अब financial asset क्या होता है? Financial asset is a cash or equity instrument of another entity or contractual right to receive cash or another financial asset from another entity or exchange financial assets or financial liabilities with another entity under the conditions that are potentially favorable to the entity. तो जो ये words लिखे हैं exchange financial assets or financial liabilities, they may include put options, call options, etc. Now on the very mirror image, we have financial liabilities definition also. What is financial liability? Financial liability is a contractual obligation. तो देखिएगा financial asset क्या था? Contractual right. तो financial liability क्या हो जाएगा मेरा? Contractual obligation to deliver cash or another financial asset to another entity. यहाँ पर क्या लिखा है? Deliver cash or another financial asset. यहाँ पर word है deliver. Financial asset में क्या था? Receive cash or another financial asset. Similarly, exchange financial assets or financial liabilities with another entity under the conditions that are potentially unfavorable to the entity. तो financial asset में word favorable था, financial liability में word unfavorable है, and it is quite obvious. If it is expense for me, then the same thing will become income for you, and if it is something expense for you, it will become income for me. In the same way, if it is liability for me, it is asset for you, and if it is asset for you, it is liability for me. The same way it will go on. एक बार फिर से मैं रिपीट करता हूं, फिर मैं एक्सेल शीट पे आपको दिखाता हूं. हमने क्या क्या समझा? फर्स्ट इज फाइनेंशियल इंस्ट्रूमेंट. What is financial instrument? It is a contract, number one, which results in financial asset of one entity, and then number third is it results in financial liability or equity instruments of another entity. What is financial asset? It is cash or equity instrument of another entity or a contractual right to receive cash or another financial asset or exchange financial assets or financial liabilities under the favorable conditions. What is financial liability? It is a contractual obligation to deliver cash or another financial asset or to exchange financial assets or financial liabilities with another entity under the potentially unfavorable conditions. Having said that, when to recognize financial instruments? ध्यान से समझने वाली बात है. An entity shall recognize a financial asset or financial liability. तो हमने पहले पता कर लिया कि फाइनेंशियल इंस्ट्रूमेंट है कि नहीं, उसके बाद ये पता किया कि कौन सा फाइनेंशियल इंस्ट्रूमेंट है, क्या ये मेरे लिए फाइनेंशियल एसेट है या फाइनेंशियल लायबिलिटी है. तो अगर फाइनेंशियल एसेट या फाइनेंशियल लायबिलिटी होगा, in that very case I need to recognize the same in my books of accounts, and that's why the principle says an entity shall recognize a financial asset or financial liability in balance sheet only when entity executes contractual agreement involving the instrument. आप खास ध्यान दीजिएगा, I have underlined the words entity executes the contractual agreement. So the very moment you execute the contract for financial asset or financial liability, you will do the accounting for financial asset or financial liability irrespective of whether you have paid any cash or not. Having said that, let me ask you certain questions on my Excel sheet. So I am sharing my Excel sheet. Vivek ji, please confirm kar dijiyega once my Excel sheet is visible to you.
Sure, sure, भैया.
Are you able to see my Excel sheet?
Yes, भैया, yes, भैया.
Perfectly visible.
तो अब आपको मैं कुछ सवाल पूछूंगा. Please try to give me the answers. Once you will go through this Excel sheet, each one of you would be in a position to understand whether the items appearing in your balance sheet are financial instruments or not. एक बार financial instrument समझ में आ गया कि होता क्या है, then we can proceed to the next step, that is classification. So classification हम बाद में समझेंगे, पहले ये देखते हैं whether the given items in my financial statements can be taken as financial instruments or not. तो देखिएगा, किसी भी आइटम को फाइनेंशियल इंस्ट्रूमेंट बनाने के लिए मुझे चार चीजें चाहिए. आई रिपीट, किसी भी आइटम को फाइनेंशियल इंस्ट्रूमेंट बनाने के लिए मुझे चार चीजें चाहिए. पहली चीज, देयर मस्ट बी अ कॉन्ट्रैक्ट. नंबर सेकंड, इट मस्ट रिजल्ट इन असेट फॉर वन पार्टी. नंबर थर्ड, इट मस्ट रिजल्ट इन लायबिलिटी फॉर अनदर पार्टी. एंड नंबर फोर, इट मस्ट बी सेटल्ड इन कैश और इक्विटी. सो कॉन्ट्रैक्ट हो, एक पार्टी के लिए असेट बनता हो, दूसरी पार्टी के लिए लायबिलिटी बनता हो, एंड नंबर फोर, इसका सेटलमेंट कैश या इक्विटी मोड में होना हो. So I repeat, if all these four parameters are present, I repeat, if all these four parameters are present, what are these four parameters? Contract, asset for one party, liability for another party, and settlement in cash or equity. If all these four parameters cumulatively are present, then the given item shall be taken as financial instrument. And that given item being financial instrument could be either a financial asset or a financial liability. I repeat once again. If for a given financial statement item, all these four parameters are present, I am moving my cell pointer. All these four parameters are present. What are these four parameters? Contract, asset for one entity, liability for another entity, whose settlement is going to be in cash or equity. Then it will be taken as nothing but financial instrument. तो एक एक करके समझते हैं. Let us assume the first item is trade receivable. So अभी हमें देखना है कि अगर मेरी बैलेंस शीट में ट्रेड रिसीवेबल है, if my balance sheet is having trade receivable, whether this trade receivable is a financial instrument or not. Let us ask a question to ourselves. Whether trade receivable is arising out of contract? Yes, it was the sales contract. Whether it is resulting in asset for one party? Yes, it is resulting in asset for one party. That is, for example, sundry debtors. Whether it is resulting in liability for another party? Answer is yes. अगर मेरे लिए ट्रेड रिसीवेबल है तो आपके लिए ट्रेड पेबल हो जाएगा. Whether it will be settled in cash or equity? Yes, at a given point of time as per the contract, either you will pay me cash or you will issue me equity shares for consideration other than cash. Because answer to all these four parameters is yes. Because answer to all these four parameters is yes. What will happen? Can we say trade receivable is financial instrument? Answer is yes. अब एक बार यहां पर भी देख लेते हैं. Let us assume the second item is trade payable. क्या trade payable financial instrument बनेगा? Whether trade payable is financial instrument, let us ask question to ourselves. Whether trade payable is arising out of a contract? Yes. There could be purchase contract. Whether it is asset for one party? Yes. Whose asset it will be? The counterparty. So yes. Whether it is liability for another party? Yes. For me it is a liability. Whether it will be settled in cash or equity? Yes, at a given point of time as per the purchase contract, either I will pay cash or I will issue equity shares for consideration other than cash. Because answer to all these is yes, it is also the financial instrument. I believe it is clear to all of you. Now, having said that, I will come to this very block at a later stage. Please tell me आपकी बैलेंस शीट में जीएसटी का आईटीसी या जीएसटी पेबल आ रहा है, whether it will be taken as financial instrument? You can give me your answers by unmuting your video or unmuting your chat box.
No.
Is it a financial instrument? Answer
No,
is
no, 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 no.
no. Just see how. Whether it is contract?
No.
No.
It is not a contract. It is arising because of the statutory obligation.
Yeah.
Because ये contract नहीं है, statutory obligation की वजह से आ रहा है, तो पहली condition का आंसर क्या हो गया? No. But whether it is asset for one party? Yes. It is liability for one party? Yes. It will be settled in cash or equity? Yes. But the answer will remain no, because एक का आंसर no हुआ है. So all the answers must be yes. Because answer is no to one of the parameter, it cannot be considered as my financial instrument. Having said that, let us come to this very area. Security deposit for electricity connection. So you are a company, you have electricity connection, and to take this electricity connection, you have given some security deposit. The question arises, if you have given security deposit for electricity connection, can it be taken as financial instrument? Yes, you can give me the answers. So let us ask a question. Have I given security deposit under a contract? Answer is yes.
Yes.
I have given under a contract. Is this asset for one party? Yes. In my books, security deposit will be shown as an asset. It is short-term asset, long-term asset? That is not my discussion agenda as of now. That we will discuss when we will discuss classification. Is it the liability for another party? Yes, it is the liability for electricity company. Will it be settled in cash or equity? Yes, it will be settled in cash or equity. I'm assuming that the security deposit will be refunded to you. So it will be refunded in cash mode, meaning thereby it is taken as financial instrument. What about retention money? You executed some building works and out of rupees 100 payable to you, rupees 80 was paid and 20 rupees was retained by the concerned client. So the client has not paid you rupees 20, it will be taken as retention money. Whether this retention money is a financial instrument, yes or no?
Yes. Yes.
Let us analyze. Retention money is kept under a contract? Yes. Is it asset for one party? Yes, it is an asset for you. Is it liability for another party? Yes, it is the liability for the client. Will it be settled in cash or equity? Answer is yes. Meaning thereby it is again but nothing but the financial instrument. So what I am demonstrating here is, I'm simply demonstrating whether a given item could be financial instrument or no. I am nowhere discussing, I repeat, I am nowhere discussing classification of financial assets or classification of financial liability. That I will discuss after completing this Excel sheet. Because once this Excel sheet is clear to you, classification will not be that much challenging. Okay, tell me the answer. Other item is prepaid expenses. Whether prepaid expenses are financial instruments?
No.
The reason for no is, what
It
could
is
be the
not a
reason of
contract.
no?
It's not a contract.
Let us assume you prepaid your telephone expenses.
Yeah.
Now, if you prepaid your telephone expenses, didn't you pay this amount under a contract? You are having a contract with the Vodafone or Airtel company to have that connection. So contract, yes,
Hello.
it is a contract. Is it asset for one party? Yes. Liability for other party? Yes. Will it be settled in cash or equity? No. It will be not settled. Rather, it will be adjusted with the future expenses. So it is not a financial instrument. Prepaid expenses are adjustable. They are not refundable or settleable. What about loans receivable?
Yes.
Answer is yes, on the same grounds. That is
Yeah.
nothing but this trade receivable grounds. What about loans payable? Yes, it is also a
Yes.
financial instrument. Okay, what about income tax refund?
No.
Is income tax refund a financial instrument?
No.
No. Why? The reason is this way.
Yeah.
It is not under a contract. That's why it is not considered as financial instrument. How about advance tax?
No.
Advance tax is a financial instrument? No. Why? Because it is paid under a statutory
Yeah.
obligation, not under
Yeah.
a contract. What about investment in debentures?
Yes.
Is it a financial instrument? Answer is yes.
Yes.
Because you made investment in debentures via some prospectus, via some offer, and that's a contract. Investment is asset for you. and such investment is liability for the corporate entity, and it will be settled in cash or equity at certain stage of time. So it is nothing but a financial instrument. But about lease receivable,
Yes.
lease receivable is also a financial instrument because it is a contract and it is a set for one party, liability for other, and it will be settled in cash or equity. How about financial guarantee? Whether financial guarantee is a financial instrument? You must be thinking financial guarantee is a contingent liability. But the fact is, if you will see Schedule 3, Division 2nd for IND AS, they have stated disclose contingent liabilities other than financial guarantees. So Schedule 3 primarily is not considering financial guarantee is contingent liability. So Schedule 3, if you will see Schedule 3, Division 2nd, financial guarantees are not disclosed as your contingent liabilities. So question arises on the same footing whether financial guarantee is a financial instrument. So let us analyze whether financial guarantee was executed under a contract. Yes.
Yes.
Is it a set for one party?
Yes.
Yes. If somebody will default, then it will be nothing but payable amount to that. So it will be liability for one party also. It will be settled in cash or equity. Answer is yes.
Yes.
So
Yes.
it is
All yes.
also a financial instrument. So please understand, let me make one thing again very clear. I'm not discussing anything about the measurement also. So I'm not discussing measurement, I'm not discussing classification. We will discuss that after certain moments. The very first prime motive is to make you people understand whether a given item in my balance sheet is a financial instrument or not. So first step is identify the financial instrument. Second step is classification. Third step is measurement. So second and third step we will discuss after certain stages. How about bank overdraft? Is bank overdraft a financial instrument? Bank overdraft is under a contract? Yes. Is it asset for one party? Yes. Liability for other party? Yes. Settlement in cash or equity? Yes. So it is nothing but your financial instrument. What about lease payable?
Same.
Is it a financial instrument? Yes. What about self-assessment tax payable?
No.
No.
Answer is no. So this will be because of this very reason.
Statutory requirement. Yeah.
Statutory requirement. How about PF ESI payable?
No.
No.
No. Because the reason is same, statutory requirement. What about bank FD?
Yes.
Yes.
Are you saying yes because I copied pasted yes?
No. No. It is your financial assets.
What about bills receivable?
Yes.
Yes. Same way for bills payable. What about call option?
Yes.
Yes.
Yes. If you remember, the words used were receive financial asset under favorable conditions. It is nothing but call option.
Yeah.
Put option, yes. Interest rate swaps, again, yes. What about advance receipt for goods?
Yes.
Answer is yes, but there is a condition. If I will assume that this advance is refundable, it will become no, then it will become no. So it all depends. Sorry, if I assume that advance is not refundable. So if the advance is not refundable, in that very case, it will
Or
become
adjustable against only supply of goods.
yes. In that very case, what will happen? This settlement parameter will not be fulfilled, and
Yeah.
then it will not be classified as financial instrument. So assumption based answers can change. What about advance given for goods on the same parameter?
Yeah.
It may or it may not be financial instrument. What about convertible loan?
Yes.
Yes.
Yes. So I am again emphasizing, I am not discussing classification and measurement. And for the timing, it will be taken as nothing but your financial instrument. Now, one question is pending. Investment in redeemable preference shares of L&T.
200 50 का तो
Investment in redeemable preference shares of L&T. Will it be taken as financial instrument?
Yes. Yes.
Answer is yes. First and the foremost thing is, when people say that why we should learn IND AS because I am a taxation guy or I am a corporate law guy, we need to understand that first is the accounting, then is the transaction, and then is the taxability or a corporate law compliance. Now, when I say investment in redeemable preference shares, section 55 is there in Companies Act, which says that redeemable preference shares cannot be issued. And because redeemable preference shares cannot be issued, we have to settle it at certain point of time, either in cash or by issuing equity shares. And that's the reason settlement, I emphasize the word settlement of such preference shares is somehow legally bound scenario. and that's the reason it will be considered as financial instrument. So
Sir,
investment.
another point is that in India it is not issuable, but in another country it can be issued.
Yes, that is the, I am discussing about Indian jurisdiction only because I am discussing Ind AS.
Yeah.
But yes, if preference shares could be of a nature which is irredeemable, it will take the character of equity, then it will be
Yes.
considered as other equity instrument.
Yeah.
So I believe from this very Excel sheet at a macro level, each one of you is in a good position to understand which item becomes financial instruments in what cases. Only 4 parameters are there: contract, asset for one party, liability for another party, and the settlement clause. Shall I proceed further? Can I assume that all these things are clear?
Yeah.
Yes, sir.
Okay, so I am proceeding further. I am switching over my screen and coming back to my PPT. Now, having understood what is financial instrument, the next step would be, my PPT is visible?
Yes.
So next step would be nothing but classification. This classification is very, very important. Why? Because the way you classify financial assets or financial liabilities will also define the measurement. So what you need to understand, you can note this sentence also: measurement of financial instruments is dependent upon classification of financial instruments. So financial instruments shall be classified into financial assets and financial liabilities, and then financial assets and financial liabilities also do have some sub classifications. People do find these sub classifications as heavy dose. I will try my level best to make this heavy dose as a mild dose with the help of one Excel numerical. But before we delve into Excel numerical, let us understand theoretically what the standard states. So we do have financial assets and financial liabilities. The standard Ind AS 109 says financial assets can be classified into 3 categories: amortized cost category, fair value through profit or loss category, which is also known as FVTPL category in industry slang. Third one is fair value through other comprehensive income category, which is also known as FVTOCI. If you see, financial liabilities can be classified only in 2 categories. OCI category is absent. Financial liabilities can be classified into amortized cost category or fair value through profit and loss category, FVTPL. I'm assuming that we people understand what is other comprehensive income. And if there is a bit of doubt what is other comprehensive income, for the time being, you can simply take, as a layman, you can simply take other comprehensive income is the area below P&L, whereby we take the accounting of notional gains and notional losses. It's a very layman scenario. So what we need to understand, financial assets can have 3 categories: amortized cost category, FVTPL category, or FVTOCI category. Financial liabilities only have 2 categories: amortized cost category and FVTPL category. Let us understand one by one. Please be very, very careful. And immediately after this discussion, I will come to my Excel sheet for solving a numerical problem. That numerical problem will clear away all the doubts. So first, I am discussing classification of financial assets. How to classify financial assets is dependent upon business model of the entity. I repeat, how to classify financial assets is dependent upon business model of the entity. Now the standard says, if the business model of entity for managing the financial assets fulfills CCFC test. CCFC stands for contractual cash flow characteristics test. Listen once again my words. If entity's business model is there for managing financial assets which fulfills contractual cash flow characteristics test, in that very case, it will be categorized either into amortized cost or OCI category. Now, these are some heavy words. Let us keep it as a layman. I'm saying something in Hindi. Please understand this Hindi sentence. Then I will come to English sentence for this standard. अगर आपका फाइनेंशियल असेट रखने का ऑब्जेक्टिव, रखने का मकसद स्पेसिफाइड डेट्स पर, देखिएगा पहला ब्लॉक, स्पेसिफाइड डेट्स पर कैश फ्लोज कलेक्ट करने का है। आई रिपीट, अगर आपका फाइनेंशियल असेट रखने का मकसद, रखने का ऑब्जेक्टिव स्पेसिफाइड डेट्स पर कैश फ्लोज इकट्ठा करने का है, और ये कैश फ्लोज केवल और केवल सोलली, केवल और केवल प्रिंसिपल और इंटरेस्ट की पेमेंट को रिप्रेजेंट करते हैं, तो उसको हेल्ड टू कलेक्ट मॉडल कहा जाएगा और इसको अमोर्टाइज्ड कॉस्ट कैटेगरी में रखा जाएगा। सो लिसन माय सेंटेंस वंस अगेन, कोरिलेट फ्रॉम द स्क्रीन। पॉइंट नंबर 1, if your business model is having this objective, what is the objective? The financial asset is held, the financial asset is held to collect contractual cash flows, and the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. उदाहरण के लिए, एग्जाम्पल के लिए, let us assume you are Punjab National Bank, you gave a loan to some party. If you have given loan to some party, what is your objective? Your objective would be on specified dates you will collect cash from him which will represent principal and interest, which is known as EMI. So what is the objective of your business model? Being Punjab National Bank, the objective of your business model is to collect contractual cash flows which are representing solely the payments of principal and interest. If it is so, in that very case, such loan receivable by Punjab National Bank will be categorized as amortized cost category. Calculations कैसे होंगी वो भी हम देखते हैं. Second example, let us assume your company is XYZ Limited, other company is RST Limited. I am assuming both are unrelated parties. So one company is XYZ Limited, other company is RST Limited. XYZ Limited gave loan to RST Limited, and what was the objective? That RST Limited will repay the loan as per predefined schedule, and when it will repay not only principal but as well as interest. In that very case, for XYZ Limited, the loan given to RST Limited will appear in balance sheet as loan receivable, but this loan receivable will be sub-classified under amortized cost category. I believe this is clear. What is amortized cost category? Now, definition of amortized cost, how it is calculated, I will come to that stage later on. The first motive of mine is that you people must understand where to classify. So when the objective is purely to collect contractual cash flows, it is known as held to collect model, and it will be classified into amortized cost category. Suppose that in addition to this objective, that is collection of contractual cash flows, you have one more objective, selling financial assets. Now, if your objective is also coupled with the selling of that very instrument, then it will be taken as other comprehensive income category. See the second point. Financial asset is held for both collecting contractual cash flows and selling financial assets. The financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on principal amount outstanding plus selling the financial assets. So objective is not only collecting the contractual cash flows, but objective is also coupled with selling of the financial assets. In that very case, it will go to other comprehensive income category. For example, you are asset reconstruction company. And in your balance sheet, you have some loan receivables. Now what happened? You were collecting EMIs on such loan receivables, but one day you decided to sell the asset. So in that very case, if at the very beginning, your objective was not only to collect EMI, but to sell such very loan receivable to any other NBFC or any other ARC means asset reconstruction company, then it will be classified under the category other comprehensive income. For example, you have invested in certain debentures. The motive of investment into debentures is not only to receive principal and interest amount, but also to dispose of such investment in debentures, it will go to OCI category. You have your fixed deposit FD in a bank. Now the objective of having FD in the bank is not only to collect principal amount and interest amount, but also to dispose of in near future. It will go to FVTOCI category. So I believe this OCI category is also clear. Now third one is FVTPL. If any of the financial instrument being financial asset cannot be classified into amortized cost category or FVTOCI category, then it will be classified into FVTPL category. That is also known as residual category. Now I will show you examples. Don't worry about that one. Now what is amortized cost? Simply putting, collection of contractual cash flows. What is OCI category? Collection plus selling of financial assets. What is FVTPL? It is a residual category. On the same replica, we have financial liabilities also. As we have just seen, financial liabilities can be classified only into amortized cost category or FVTPL category. So what does the standard says? All, see the word all financial liabilities are measured at amortized cost. All financial liabilities are measured at amortized cost. So it's the default category, amortized cost. However, there are 5 exceptions. All financial liabilities are measured at amortized cost except those financial liabilities which are measured at FVTPL, and hence they shall subsequently be measured at FVTPL. That means on your own, at the inception of financial liability contract, you classified into FVTPL. अगर आपने शुरुआत में ही, beginning में ही किसी financial liability को FVTPL category में classify कर दिया, then it will remain into FVTPL category because the standard says financial liabilities cannot be reclassified. I repeat, financial liabilities cannot be reclassified into any other category in future. Transfers that do not qualify for derecognition, that is continuing involvement approach. आपने financial liability किसी और को assign कर दी, आपने financial liability किसी और को assign कर दिया, transfer कर दी, लेकिन उसके अंदर आपका continuing involvement है, तो आप उसको FVTPL पर लेकर जाएंगे. I will show you one example for this. Financial guarantee contracts. So financial guarantee contracts shall be measured on FVTPL basis. Commitments to provide at below market interest rate, again it will go to FVTPL. Contingent consideration. I believe the next speaker will be covering this contingent consideration because it deals with business combination agendas. So if all or any of these 5 exceptions are present, then these shall be classified and measured in FVTPL category. Having said that, see this question, and please tell me in this question where the liability shall be classified, whether it will be classified into amortized cost or FVTPL. So the question is, ABC Limited was liable for rupees 10 lakhs to PNB Limited. The company's books also show amount receivable for 15 lakhs from RST Limited. Accordingly, ABC entered into tripartite debt assignment agreement with RST and PNB, whereby RST will pay to PNB a sum of rupees 10 lakhs as full and final settlement on behalf of ABC Limited. The agreement also stipulates that if RST Limited defaults in such payment, then PNB can have recourse to ABC Limited. So ABC ने 10 लाख रुपए PNB को देने थे. ABC ने कहा PNB को कि आप ये 10 लाख रुपए RST Limited से रिकवर कर लीजिएगा because RST से ABC ने 15 लाख रुपए लेने हैं. एक एग्रीमेंट साइन हुआ ABC, RST और PNB में. एग्रीमेंट में लिखा गया कि अगर RST ने PNB को ABC के behalf पर 10 lakhs rupees नहीं दिए, in that very case PNB can get back to ABC for recovery of the amount. Now my question to you people is, in the books of ABC Limited, whether this rupees 10 lakhs of liability towards PNB shall be classified under amortized cost category or under FVTPL category? Any answers?
FVTPL.
It will be FVTPL category. Why? Because there is continuing involvement.
And there is also guarantee part is also there indirectly.
Yes, absolutely. So because there is a continuing involvement, there is a kind of guarantee also, because ABC is having continuing involvement despite assigning the obligation. it will be categorized, that is rupees 10 lakh shall be categorized into FVTPL category. Now I am using the words amortized cost because standard uses the word. So how they have defined amortized cost? To go to amortized cost definition, you have to wait for some moments. Let us first do certain numericals. विवेक जी एक बार कंफर्म कर देना जब मेरी एक्सेल शीट नजर आए.
Sir, I have a question.
Yes sir.
In the example you have given for ARC, selling that particular assets and also getting, EMI. If same thing is done by bank also, sells its portfolio of loans and all.
Yes,
so in
sir.
that case, how it will be classified?
Sir, for banks, I cannot comment anything as of now because IND AS have not been made mandated for banks.
Okay. Okay.
So
Thank you.
RBI working group committee is working on the same front. But yes, as of now, if I assume hypothetically for banks, in that very case, the same principle will be applicable. So it's a
Okay, sir.
hypothetical answer only.
Yeah. Thank you.
So let us understand all this amortized cost FVTPL stuff, and you will find it very easy and manageable. Whatever Excel sheet you are seeing, just be very careful. So all these are hypothetical examples just to make the things clear. First and the foremost thing, keep one sentence in mind, which I am just stating. Amortized cost considers, I repeat, amortized cost considers two main elements. I repeat, amortized cost considers two main elements. One is transaction cost and then effective interest rate. I repeat, amortized cost considers two main elements. One is transaction cost and second is effective interest rate, EIR. Keep these two expressions, number one, transaction cost, and number second, effective interest rate, in your mind. Just see the calculation, how I am doing the calculations. Once you will understand the calculations, then I will come back to the PPT to show you the definition of amortized cost. After understanding this numerical, definitions automatically will be clear. So this is question number one. In the beginning of year 2001, RST Limited purchased the bond with maturity on 31st December 2005. So this could be bond or debenture as the case may be. Purchase price of bond was 9800 equal to bonds fair value. So 9,800 is bonds fair value and it incurred transaction cost of 150. So please take a note of this transaction cost. Rupees 150 is the transaction cost, and I told you amortized cost considers transaction cost and effective interest rate. The bond has a face value of 11,000 and pays annual coupon of 5% payable on 31st December each year in arrears. The bond trades for 90.91 after coupon on stock exchange as at 31st December 2001. So 31st December is the financial year end date, reporting date. Now, advise RST Limited how to recognize gains or losses from bonds subsequent measurement if, number one, the bond meets contractual cash flow test and is held under business model whose objective is achieved through collecting contractual cash flows. Number second, the bond meets contractual cash flow test and is held under business model whose objective is achieved through collecting contractual cash flows and selling. And number third, the bond does not meet business model test. So before we go for measurement, let me have a small recapitulation. I just told you, first step is identifying the financial instrument. Second step is classification. Third step is measurement. Now you understood what is financial instrument. You understood what is classification, but we have to understand now what is measurement, how the things are measured. So before we go to measurement principles, please tell me whether I am correct or incorrect. Can I say in this question, this first sub question is amortized cost category, this second sub question is OCI category, and this third sub question is P&L category? Can I say this thing, yes or no? I presume the answer is yes. Now, the first part of the question is, if the bond meets contractual cash flow test. So the standard was saying if contractual cash flow test is fulfilled, then you have to classify the financial instrument into amortized cost category. First of all, let us check whether this bond is a financial instrument or not. Answer is yes. Bond was under the contract. Bond is asset for you. Bond is liability for other party. And number 4, the settlement of this bond will be made by cash or equity mode. So bond is a financial instrument. First part of the question says bond is held for contractual cash flows collection, and that's why it is amortized cost category. I told you amortized cost category means 2 elements: transaction cost and effective interest rate. To compute effective interest rate, you have to arrive upon a substituted cost after considering transaction cost. That substitute cost is arrived like this. So just see, first case is, this is the first case, bond meets contractual cash flow test. So what is the business model? Collecting cash flows, and hence it will go to amortized cost category. Since bonds contractual cash flow test and business model of collecting cash flows is fulfilled, it will be classified into amortized cost, and hence it will be measured at amortized cost principles as well. So how it will be measured initially? Fair value is 9,800. What is the transaction cost? 150. So total will be 9950. Please understand, when you are measuring at amortized cost category, transaction cost need to be considered. So directly attributable transaction cost is 150 for this purchase, and hence it will be deemed that the investment is for 9950. So what will be the journal entry? The journal entry will be bonds asset account debit, cash account 9950. So this is journal entry at initial measurement. Now we need to do subsequent measurement also. Subsequent measurement shall be done at amortized cost category. Now please be careful. For subsequent measurement, you have to prepare this amortized cost table. I repeat, you have to prepare this amortized cost table. Just see very carefully. At the beginning, what is the cash flow? Minus 9950. You paid 9,800 for investment, and you incurred 150 transaction cost thereon. So total cash outflow is 9950. 5 year is the investment horizon. So each year what you will get coupon amount 550. How? 5% was the coupon rate. Just see, 5% is the coupon rate. 11,000 was the face value. So on face value, you will get the interest. What is the interest you will get each year? 550. And in the 5th year, what you will get? Not only interest, but the principal amount. Now, what you will do, you will compute internal rate of return. How you are computing internal rate of return? You will apply a formula in this amortized table is equal to IRR from this to this. Just see what I did. I'm displaying the formula. IRR C29 to C34, automatically Excel will compute IRR. This IRR is known as effective interest rate. I repeat, this IRR is known as effective interest rate. How this effective interest rate is computed? This effective rate is computed after considering the transaction cost. So in this very item, transaction cost is included, and on this very basis, I am getting effective interest rate of 7.35%. So what is the actual interest rate? Actual interest rate is 550, computed at rate of 5%. So actual interest rate is 5%. Effective interest rate is 7.35%. So when we do accounting under amortized cost category, we consider transaction cost and IRR or effective interest rate. Now just see how the interpolation is done. Amortized cost is 9950 at the year end. What is the interest? Now the interest income on bond. I repeat, interest income on bond for the purpose of P&L shall be computed on the basis of effective interest rate and not on the basis of actual interest rate. So effective interest rate is 7.35%. And then we computed the interest income, that is 731. So what is the amortized cost I'm getting? 10,131. General entries I will show you. Now this 10,131 will become closing balance. For the next year, it will become the opening balance. On this very balance, you will compute again the interest income at the rate of 7.35%. That is the effective interest rate. Then you will get another amortized cost, 10 to 326. So all these things are known as amortized cost, and this is also known as GCA. What is GCA? GCA means gross carrying amount. So this is also GCA, this is also GCA, this is also GCA, and this is also GCA. So all these year by year amounts are known as amortized cost. So what I was stating that interest income shall be booked in P&L under amortized cost category, but not at actual rate of interest, rather at effective rate of interest. So see the journal entries. What will be journal entries for each year? Booking of interest income. So investment in bond account debit to interest income, or you can simply say to P&L 731. How the 731 is coming? This is the first year interest income on the basis of effective interest rate. Then is receipt of cash. What you will receive? You will receive 550 rupees. So you will pass the journal entry cash account debit 550 to investments in bond account 550 rupees. This way the journal entry will be passed on year by year basis. And when you pass these kind of journal entries under this scheme, after considering transaction cost and computing effective interest rate, this is known as amortized cost category. So I believe this amortized cost category is clear to each one of you. Now what was the second question? Second question was, the bond meets contractual cash flow test and is held under business model whose objective is achieved through collecting contractual cash flows and selling. So selling motive is also coupled now. And I was telling you, when selling motive is coupled, it will travel into OCI category. And that's why if you see in this second sub part, the categorization is measured at fair value through other comprehensive income. So can I say other comprehensive income by default includes amortized cost calculations? Answer is yes, because in other comprehensive income category, first is held to collect model and then is the selling model. So first we will do journal entries in the same way as we did for held to collect model, that is amortized cost category. So how the things will be propelling? In the statement of financial position, the bonds will be measured at fair value. This is the new thing. In P&L, amortized cost amounts will go as interest income. In other comprehensive income, fair value changes will be traveling. Just see how. So initial measurement is the same way as we did in the first sub question. The same initial measurement is going on, same journal entries there, same amortized cost table is prepared here also. So there is no change. And as I told you, this is known as GCA, that is gross carrying amount. There will be no change in this very nomenclature also. Up till here, there is no change. Journal entries, again, there is no change. Now, what is the change then? The change is coming up because of one couple entry, that is selling objective. Now, because there is selling objective, what I will do? Changes in fair value of bond will be traveling to other comprehensive income statement. So what I will do? I will compute fair value as on date. So what is the market price? Market price is 90.91 given in the question. Face value was given in the question 11,000. So fair value as at reporting date is 10,000. What is the amortized cost? 10,131. From where it is coming? Just see. It is coming from this place, amortized cost table. So amortized cost is 10,131. Fair value is 10,000. Meaning thereby, आपकी बुक्स में जो कैरिंग वैल्यू है वो 10,131 की है. मार्केट में आपको 10,000 रुपए मिलेंगे. That means there is a loss of 131. So this loss will be dumped into other comprehensive income. So my journal entry will be other comprehensive income account debit to investments in bonds account 131. So when this kind of scheme is propelled, it becomes nothing but FVTOCI category. FVTOCI means amortized cost category plus selling objective. So what is selling objective signifying? Selling objective signifies accounting for changes in fair value vis-a-vis amortized cost as on balance sheet date. What was the third question? Third question was bond does not meet the business model test. So if the bond is not meeting business model test, where it will go? It will go to FVTPL category. Just see how. So bond does not meet business model test. So classification will be FVTPL. Now, when it will go to FVTPL, the elements which I discussed for amortized cost category and OCI category, that is effective interest rate and transaction cost, will not be treated in the same way. So what will we doing? At initial measurement, just see, at initial measurement, transaction cost is not considered in this way. Journal entry will be bonds debit 9800, P&L account debit for financial expenses 150, and to cash account 9950. Just see, in this very area for FVTPL category, finance cost, that is transaction cost, is not considered the part of your investment in bond. It is separately accounted for as an expense because it is measured on fair value basis. Now on balance sheet date, what I will do? On balance sheet date, I will compute fair value. Now books are saying something and fair value is something. So as per the books, fair value is 10,000. As per the market, the fair value is 10,000 and 9,800 is the fair value as per the books. So market में 10,000 रुपए हैं, books में 9,800 rupees की fair value है. That means 200 is the gain. So what will be the entry? This gain will go to P&L. Just see how. Bonds account debit to P&L, 200 rupees of gain. When this interest will be received, you will pass on more entry, cash account debit 550 to P&L, interest income 550 rupees. I believe this question is clear to each one of you. Please say yes or no so that I can proceed further. Shall I proceed further? Is this question clear?
Yes, sir. Yes, sir. You proceed further. If any question, we'll take at last.
Okay, so I presume that these three categories, amortized cost, P&L, and OCA, are clear to each one of you. See the second question. In the beginning of year 2001, RST Limited purchased 1 lakh rupees 2 listed equity shares in ABC Corporation for the price of rupees 3.5 per share. RST Limited paid fees of rupees 2,000 in relation to purchase. On 14th November 2001, Razor received dividend of rupees 0.05 per share. On 31st December 2001, the shares were traded at rupees 2.8 per zero. Advise Razor how to recognize gains or losses from shares to subsequent measurement if shares meet neither business model test nor contractual cash flows test. Razor bought the shares in order to get profits from changes in market price. And number third, Razor bought shares in order to receive dividends from ABC Corporation. RST Limited would like to avoid volatility in P&L resulting from changes in market price. See, the very first thing is, in this very question, the investment is being made into equity shares. And when investment is being made in equity shares, there can be no question of contractual cash flows. I repeat, there can be no question of contractual cash flows. Why I'm saying so? I'm saying so because whatever dividend you get on equity shares, they are arising not out of contract, but out of corporate decision. And that's the reason investment in equity shares can never meet the business model or contractual cash flow test. And hence the same thing is written here. The shares meet neither business model nor contractual cash flow test. Only debt instruments are assessed for business model or contractual cash flow test, not the equity instrument. The reason is simple. On equity, dividend is paid, and dividend is paid out of corporate action, not out of any contractual obligation. The question was saying, but you will treat if the shares bought were to get profits from the changes in market price. So if the shares are so bought, in that very case, they will be measured at FVTPL, because if anything cannot go into amortized cost category or OCI category, it will go to P&L category. Primarily, these shares signify that they're being held for trading purposes. When the shares are held for trading purposes, they shall be measured on FVTPL basis. So what is the market price? 3.5 per share. Amount purchased is 1 lakh. So fair value will be 3,50,000. So what will be journal entry? Shares account debit 3,50,000. P&L account debit 2,000. That is the transaction cost. To cash account 3,52,000. Subsequent measurement, market price came down to 2.80. Shares are 1 lakh. Fair value will be 2,80,000. So there is a loss. 3,50,000 minus 2,80,000. 70,000 is the loss. And that's why the journal entry will be P&L account debit towards fair value loss 70,000, to investment in shares 70,000. You will receive the dividend. So once you will receive the dividend, you will pass the journal entry cash account debit to dividend income 5,000 rupees. Now the third question was saying, third sub question was saying that shares are not held for trading, but the shares are held for receiving dividends. But dividends are not contractual amounts. So dividends are as a kind of outcome of corporate action. So when shares are held to receive dividends, the classification will not be through FVTPL, but will be through OCI. And the journal entries will be same. Only thing is there will be slight change of fair value gain or loss accounting, which will be done through OCI category. So what you need to remember, the major thing which you need to consider here is this very block which I'm highlighting. Only debt instruments are assessed for business model or contractual cash flow test, not the equity instruments. So with this very small discussion, I have attempted to discuss at length what is financial instrument, how they're classified, and how they are measured. I am coming back to my PowerPoint presentation to discuss further things. Now, once you have recognized financial assets or financial liabilities, the next question would be about their derecognition also. Now, what are the principles? The principles of derecognition can be discussed separately for derecognition of financial assets and derecognition of financial liabilities. Let us discuss one by one. Standard IND AS 109 says an entity shall derecognize a financial asset only when the contractual rights to cash flows from financial asset expire, or it transfers the financial asset and the transfer qualifies for derecognition. So primarily what is happening, when the contract itself get expired, then derecognition will happen. In a bird's eye view, what I can say, standard says where all the risk and rewards of ownership with respect to such financial asset has been transferred substantially, then derecognize the financial asset and recognize separately the obligations created or retained in such transfer. If all the risk and rewards of ownership are retained substantially, then you will keep on recognizing the financial asset. So when substantial transfers of risk and rewards have taken place, only then you will derecognize the financial asset. Let us take a hypothetical example. Let us assume the company is IL and FS Limited. It is an NBFC. It has given loan to Jet Airways Limited. So when the loan was given, the journal entry passed was loan receivable from Jet Airways debit rupees 1000 crore to bank account rupees 1000 crore. Now the above loan became NPA, and hence the loan was sold or transferred to SBI Limited without any recourse option. So when we say without any recourse option, it means that SBI will not come back to IL and FS for recovery if some default takes place or some mismanagement takes place. So when this loan was transferred, the journal entry which ILFS passed was bank debit 900 crores, P&L debit 100 crores to loan receivable from Jet Airways Limited 1000 crore. This P&L debit 100 crore means nothing but the SBI service fees or discounting fees, etc. In the books of SBI Limited, the entry will be on a mirror image: loan receivable from Jet Airways 1000 crores to bank 900 crores to P&L 100 crores. Now, when you see this paragraph, without any recourse option signifies that IL and FS has transferred substantially all the risk and rewards of ownership of loan receivable from Jet Airways Limited, because loan receivable from Jet Airways is asset for ILFS, being the financial asset. Now it is transferred substantially. It means that it will be derecognized, and in order to derecognize, this head is credited. If you see the last journal entry, so last journal entry on the left hand side column is nothing but loan derecognition entry or financial assets derecognition entry. As is for financial asset, we have for financial liabilities also. But financial liabilities do have certain rules. Just see what the rule says. When I say the word rule, rule is nothing but the definition of substantial modification. So the standard index 109 has not defined the meaning of word substantially for financial assets. But standard 109 has defined certain rules for the word substantial modification with respect to financial liability. Just see what the principle says. An entity shall remove a financial liability or a part of financial liability only when it is extinguished, contractual obligation is discharged or cancelled or expired. So when liability is extinguished or contract is extinguished, then financial liability shall be derecognized. What the standard says in detail? The standard says if the arrangement between the existing borrower and the lender undergo the substantial modification. I repeat, if the arrangement between existing borrower and lender undergo the substantial modification, then there will be extinguishment of original financial liability and recognition of new financial liability. Whereas when there is a transfer to other party of such financial liability, either entirely or in part, then the difference between carrying amount and the consideration paid, including any non-cash asset, shall be recognized in P&L. So primarily the question arises whenever the existing financial liability or loans payable are refinanced, whenever there is a refinancing, whether we have to de-recognize the original loan and recognize the new loan, answer depends upon the meaning of substantial modification. So if there is a substantial modification because of refinancing, we will de-recognize the original loan and recognize the new loan. If there is no such kind of substantial modification, then there will be no de-recognition also. Now, what is substantial modification? The standard says you have to make a quantitative assessment. Now, what is quantitative assessment? If the NPV of the cash flows under the new terms, if the NPV of cash flows under the new terms means the refinanced loan amount. If the NPV of cash flows under the new terms discounted on the basis of original effective interest rate differ 10% or more from NPV of the original cash flows. So what you have to do? You have to compute NPV of the new loan and you have to compute NPV of the old loan, but both the NPVs shall be computed on the basis of effective interest rate. I repeat, both the NPVs shall be computed on the basis of effective interest rate. If the difference between these two NPVs, if the difference between these two NPVs is 10% or more, then it shall be deemed that there is substantial modification. So if the NPV difference is 10% or more, in that very case, it shall be deemed that there is substantial modification. If there is a substantial modification, then obviously you will de-recognize the original loan and you will recognize the new loan amount. And that's the principle here. Recognize gain or loss based on difference between carrying amount and the consideration paid, and then modification cost or fees incurred shall be included in the gain or loss, and then also recognize the new liability which shall be measured at fair value. So what you need to understand and underscore is this very substantial modification is defined only for financial liabilities. It is not defined for financial assets. Having said that, I have a small recapitulation. I told you I will show you definition of amortized cost at a later stage. Just see what the standard stated. What is amortized cost? Amount at which the financial asset or financial liability is measured at initial recognition minus the principal repayments plus or minus the cumulative amortization using effective interest method of any difference between that initial amount and the maturity amount, and for financial assets adjusted for any loss allowance. So primarily in a layman scenario, what I will say, amortized cost is the amount which is computed on the basis of effective interest rate method. Now, what is effective interest rate method? In applying the effective interest rate method, the entity identifies fees, that is transaction cost, that are an integral part of effective interest rate of financial instrument. Fees that are an integral part of effective interest rate of a financial instrument are treated as an adjustment to the effective interest rate unless the financial instrument is measured at fair value, with the change in fair value being recognized in the profit or loss. In those cases, the fees are recognized as revenue or expense when instrument is initially recognized. So if you remember in my calculation worksheet, when we were doing accounting of amortized cost and OCI category, the transaction cost was the part of my initial measurement, whereas when I was doing accounting for FETPL category, transaction costs were not the part of my initial recognition amount, rather it was dumped into P&L. I have a small question to be asked. Please try to answer my question. So the question is, the company is RST Limited. It has invested in 80% voting rights of LMN Limited. The amount invested was rupees, say 100 crores. The question is whether such investment in equity shares with voting rights is financial instrument. Now in this question, what is happening? RSC Limited became holding company, LMN became subsidiary company. Whether such an investment can be considered as one of the financial instrument. So what you need to remember, in terms of IND AS 32, such investments in subsidiary, if are covered under IND AS 110, that is consolidated financial statements, then such investments are not covered under financial instrument standards. So they shall be accounted for at cost as per IND AS 27. So please be under an impression, investment in subsidiaries always cannot be classified as financial instruments. It all depends upon the implications of IND AS 110, which my learned speaker in the next session will be discussing. I have one more question. RST Limited holding company gave loan to LMN Limited subsidiary company and stated that it is up to LMN when to repay the loan, but RST will have no right to demand the loan. What is the classification? So one company gave loan to its subsidiary company and stated to the subsidiary company, it is your choice when you want to redeem this loan. We will never ask for redemption. So अगर कोई ऐसा लोन दिया गया है जिसमें सब्सिडियरी को कहा हो कि जब आपकी मर्जी हो तब लोन वापस करना, हम आपसे लोन वापस नहीं मांगेंगे. In that very case, the question arises, how to classify such kinds of loan? How to classify such kinds of loan? These loans are also known as discretionary loans. How to classify such kind of loans? So what you need to remember, the answer is such loans are classifiable as other equity instruments. So I believe it is clear to each one of you. Proceeding further. Expected credit loss. Again, a very big discussion can take place on this very agenda, but I will keep it short just to give the idea what is ECL. Earlier days, we were having the habit of using the words bad and doubtful debts, bad debts. So now the things have changed. Now the things are moving towards ECL, expected credit loss model. When it was the case of bad debts earlier days, the bad debts were accounted for on incurred basis. But now under IND AS 109, such kind of bad debts are recognized on expected credit loss basis. So IND AS 109 introduces so-called general model of recognizing impairment loss. This model requires recognizing impairment losses in line with the stage in which financial asset currently is. So पहले हमें ये देखना पड़ेगा कि मेरे पास जो लोन रिसीवेबल है, whatever loan receivable I am having, is it falling into stage 1 category or stage 2 category or stage 3 category? Depending upon stage 1, stage 2 or stage 3, I will compute such kind of provision for bad and doubtful debts, which is now known as ECL, expected credit loss. By this time, you very well understand what is GCA. GCA stands for gross carrying amount. I told you in my Excel workings what is GCA. So the standard says if the financial asset is in stage 1, it is known as performing asset. If the financial asset is in stage 2, it means that it is a financial asset on which credit risk has significantly increased. If the financial asset is into stage 3, it means that such kind of financial asset is credit impaired. Now, what are these performing assets, credit risk increased assets, and credit impaired assets? I will show you in the next slide. So there are certain rules about it. Now, if the financial asset is into stage 1 category, then you have to account for ECL on 12 months basis. Whereas if the financial asset moves into stage 2 or stage 3 category, then you will compute expected credit loss for the whole lifetime of the contract. Meaning thereby, suppose that the loan has been given by you for 5 years. If such loan receivable is into stage 1 category, then you will compute ECL only for 12 months. Whereas if the loan receivable falls into stage 2 or stage 3 category, then you will compute ECL for entire remaining years. That means if loan receivable year 1 has elapsed and 4 years are only left out, so you will compute ECL for the entire 4 years. And interest revenue on such loan receivable, you have to book interest income. You will book interest income on gross carrying amount basis for stage 1 and stage 2. But for stage 3, you will compute interest revenue on gross carrying amount minus ECL. So if you remember my Excel sheet, when I was computing amortized cost, there was the opening balance from the preceding year's closing balance. So that closing balance will be taken as such opening balance if the asset is into stage 1 and stage 2 category, but that closing balance will undergo a change if the asset goes into stage 3 category. If you remember, under RBI's framework for framework of resolution of stressed assets, we have SMA, special mention accounts, SMA 0 category, SMA 1 category, SMA 2 category. On the same front lines, stage 1, stage 2, stage 3 rules are there. The standard says an asset will be in stage 1 category when it is expected to perform normally in line with their contractual terms. So when there is no risk or the risk is just negligible, which is confined to normal market risk, it will be into stage 1 category. But if such financial asset or loan receivable is overdue for more than 30 days, in that very case, it will move into stage 2 category and it will be deemed that credit risk has significantly increased. If you remember, under RBI's framework, we have SMA 0 category. SMA 0 categories amounts falling due from 0 to 30 days. SMA 0 categories 0 to 30 days. SMA 1 categories 31st day to 60 days. In this very case, what is happening? Overdue more than 30 days. It is nothing but a kind of similarity with SMA 1 category. Similarly, we have stage 3 category if amount becomes overdue for more than 90 days. So all these are rebuttable presumptions. These days can be going beyond or less, but you have to justify why it is coming into stage 2 and stage 3 category depending upon this rebuttable presumption. Why this classification is important? This classification is important because the way you classify, the way ECL will change. Because in stage 1, it is 12 months ECL. In stage 2, stage 3, it is lifetime ECL. And then interest revenue booking also undergoes a change. Just see this example. So this example of computing of ECL is also known as application of POD method. POD means probability of default method. Very simple example. To get into details, we can have some other seminars some other day for our detailed discussion. Just to give a glimpse what it is. So entity has lent rupees 1 million at initial recognition. Probability of default over next 12 months is 0.5%. How to compute this probability is not being discussed in today's session, but there are certain formulas, certain mathematical models to discuss the same. At the reporting date, there is no change in 12 months probability of default, and the entity assesses that no significant increase in credit risk since initial recognition. So what is happening? The question itself is saying that there is no increase in credit risk. But in practical world, we have to assess whether credit risk has increased or not in a significant manner. Loss given default, LGD, is determined to be 25% of gross carrying amount. What is LGD? LGD means कि मैंने 100 रुपया दिया हुआ है लोन पर, उसमें से 25 रुपए शायद नुकसान में चले जाएं, शायद ना मिले. What is the loss allowance to be recognized? Now probability of default क्या होता है? Probability of default signifies कि जो 25 रुपए नहीं मिलेंगे उनके ना मिलने की probability कितनी है? I repeat, POD means that if entity is going to have 25 rupees of loss out of rupees 100 amount of loan being given, 0.5% are the chances that rupees 25 of loss can take place. So all this will give you a multiplier equation, and hence, since there is no increase in credit risk since initial recognition, lifetime expected credit loss is not required to be recognized. We will compute only 12 months expected credit loss in this way. Rupees 1 million amount of loan, LGD 25% into 12 months POD 0.5%. This will give you 1250 of ECL. So this, just seen this question, POD is for next 12 months. Had the question said that loss has significantly increased, then this POD will travel into lifetime ECL. Let us take one more question. This is known as age bucket method. At the reporting date, an entity assesses that increase in defaults represent a significant increase in credit risk. So now the credit risk has increased significantly since initial recognition. Additional information is as under computed ECL. So question is saying that credit risk has increased significantly. That means some default must have occurred, or the number of days must have surpassed the rebuttable presumption days. So they have given the default rate along with the age buckets. Default rate is 0.3%. Those financial receivables who are falling within 1 to 30 days, they have been given as gross carrying amount, and default rate and so on goes to 91 plus days as well. Now how to compute? Simple multiplier equation. Age factors, default rate factors, GCA is given in the question. Multiply all these, column second and column third. This will give you lifetime ECL allowance 580. So what you need to understand, once you will go into depth of this standard from the bare principles, ECL can be of two types: 12 months ECL or lifetime ECL. So Vivek ji, I have tried my level best to compute and discuss as many practical aspects as I could discuss within 90 minutes. So I will not take the time of the next speaker.
Thanks a lot, Kamal ji. And actually, this standard is meant for 1 or 2 days, but to cover so much in next 1.5 hours is also a big deal. And truly speaking, expected credit loss तो समुंदर है, क्योंकि अगर वो सबको मालूम पड़ जाता तो बैंक में अभी तक इंडेक्स लागू हो जाता.
ECL will take a lot of calls.
So we look forward to have a detailed session in ECL only in month of Jan or Feb, once things also streamline and all. In the meantime, thanks a lot, Kamalji, and I request you to stay connected with us if possible, so that we can have question answer at end, or you can join like after an hour or something. In the meantime,
Vivek ji, I have one meeting lined up with one of my client, so I will join midway.
Okay, thanks a lot, Kamalji, and we'll wait for you at the end, and we'll have a official vote of thanks also at the end. In the meantime, I request our member Tarun Kumar Gupta ji to give a formal introduction to Himanshu ji. Tarun bhaiya.
Yes, thank you, Vivek. Am I audible?
Yeah, perfectly.
Thank you so much. We welcome our learned next speaker, Shri Himanshu V. Krishnadwala ji. Mr. Krishnadwala is a BCom, DCM, FCA, rank holder in both inter and CA final examination. He is a senior partner in CNK and Associates LLP Chartered Accountants based in Mumbai and having offices in Vadodara, Chennai, Bengaluru, Delhi, and other places. Mr. Krishnadwala has been in practice since 1985. So, like over, I think, 45 years of practice he is having now. Mr. Krishnadwala has very rich experience. I see in his profile, he has overseen the audit and assurance practice of the firm, particularly audit of large corporates, including Fortune 500 companies, in the AS implementation, investigations, and conversion of financial statements from IGAP to IFRS, US GAAP, etc. I will skip some part of the profile, sir, with your permission. The most important thing is that sir has been the president of Bombay Chartered Accountants Society BCAS in 2006-2007 and is very deeply involved with the institute as he is the co-opted member and special invitee in various committees like Accounting Standard Board, IND AS Implementation Committee, Expert Advisory Committee, Research Committee, Corporate Laws Committee, and various other committees. Sir, we welcome you warmly to our association, to our study circle, ACA study circle, which is one of the premier study circles in Eastern India. And with these words, sir, we request you to please start your deliberation. Thank you, sir.
Right. Good evening to all of you. Can you all hear my voice?
Yes, sir. Perfect, sir.
Right. So, good evening to all of you. It's a pleasure to be here talking to you on a very complex standard. And with ACAE, we have, I personally have a very old relationship. When I was the president of BCA, one of the first programs which we conducted with the organization outside Bombay was with ACAE. When one of your senior members, Pulak Saha, was the chairman of ACAE. Pulak now has become a good friend of mine, and we have been speaking to each other quite often now. And therefore, ACAE is something which normally I do like to be part of whenever some such sessions are there. So I can see a lot of my friends who have joined from the names which I can see. I can see Kashiji, I can see Nilima who has joined in. They are all good old friends, and I am sure it will be good to maybe sometimes physically again interact with them. But today, let us first start off with this presentation, and it's a complex subject which actually you have asked me to deal. So let me put on my slides which are there. Can you see the presentation?
Perfect, sir. Perfect.
Right. So I'll just start this. Right. So what I was asked to talk about is this intricacies of consolidation under IND AS. Now, consolidation under even the non-IND AS standards is quite complex. So under IND AS, obviously it is bound to be little more complex. And this is a presentation which we also use for our in-house, because this is a very complex standard in that sense. So we also have various trainings mainly on this consolidation within our office also. So what I have done is I have tried to take the base of the same presentation, because that is something where we have tried to cover a lot of examples from the IND AS education material, as well as some practical examples which have come in ITFG. So most of them have been covered in this particular presentation. And the presentation is also going to cover the provisions of the old standard by way of complete availability of information on consolidation. So even if you are consolidating something under the old standards, this presentation will give you that comparison right away, so that it can be useful to anyone, whether under old AS or the new AS. So the first thing which I would just like to tell is, why do you need consolidation? And as you can see, consolidation is required under various statutes. For listed companies, you have got the SEBI listing obligation and disclosure requirements. Well, all these regulations want a consolidated financial statement. Under Companies Act, you have got Section 129 and the Companies Accounting Standard rules applicable to all companies. Some exemptions which are given in Rule 6 if there is an intermediate company, and that exemption applies, which is covered in the next slide. Now, first you have to decide whether consolidation applies as per all this. And once consolidation applies, you have to follow the notified accounting standards. So they would be either IND AS 110, 111 and IND AS 28 if you are under IND AS, or it would be the old standards 21, 23 or 27 which are there. If I go on further on the rules of consolidation or what is excluded from consolidation, you have this rule 6 which allows that intermediate companies not to be consolidated with some approval of all the members in writing, provided the final company is presenting consolidated accounts. Even IND AS 110 has some exemptions which are given, which are listed down here. Say for instance, that last thing which is said, that if you are an investment entity and you measure everything at fair value through profit and loss, then you need not do consolidation, because the same purpose is served by the measuring all subsidiaries at fair value in that sense. If you look at the old standard AS 21, and everywhere in the presentation IND AS is highlighted like this in that lilac color, so that is the focus of our presentation today. The other things are really for your information and collation which is there. So that when had some exemptions if the control was temporary, which is now no longer there under IND AS 10. So in IND AS 10, even if control is temporary, you will still need to consolidate. Now in this presentation, we are going to follow the 6 steps which are there. The first thing for consolidation is really whether you need to assess whether the reporting entity has either a control or a joint control through joint arrangement, or is it a joint venture or a significant influence over the other entity. In other words, I will first decide whether it's a subsidiary, joint venture or a joint operation which is there. Only then I decide how do I consolidate, what do I consolidate, and so on. And we will see several illustrations on that particular point, on whether I have control or is it joint control or it's a joint venture or something. The second, therefore, thing after that is, what is my process of preparing consolidated statements? Once I prepare consolidated statements, I also need to get into calculating what is called my non-controlling interest, or what was earlier called my minority interest, because in all my subsidiaries, I may not have 100%. There would be minority or non-controlling interest shareholders. So how do I calculate that NCR, MI as we call it? Or even how do I calculate goodwill or gain on bargain purchase or a capital reserve? What do I do if I have got foreign operations? Because this is linked to my other IND AS 23, which is there. Then how do I do a consolidation of line by line or by equity method? Now this really applies only if you are in a joint venture situation, not in a subsidiary situation. And finally, what happens if my parent is diluting something from 100%, I go to 70%? How do I account for that within consolidation? So these are the 6 things which we are going to cover in this particular presentation. There is initial theory which is there, followed by several examples which are there on each of these items which are there as such. And in practice, these are the things which we have actually faced in our office, and the entire presentation is really based on our office experiences, and some of the illustrations are on the education material and the ITFGs, which also cover the practical queries of the various members across India in that sense. So we first go to this, how do you assess control, joint venture, significant influence? And I would suggest that if you have any queries, you can just put it in the chat box. Just say it's a query to me, and then I will take it maybe all together towards the end, or maybe towards after the end of each portion. No, I may just stop and see if there are any queries or something. So, and as I said, this presentation also covers the position under the old standard as well as the Companies Act, but our focus really is again what is highlighted in red over there. The other things are just to distinguish what has changed from the old standard to the new standard as such. Now, under IND AS 110, what we really look at is the power. Does the main company has power over the investee? And to do that, basically, or rather, do I have control? So in control, I see whether I have power over the investee, whether I have exposure to variable returns, and whether I can use my power to affect my returns which are there. Now, if I assess all these three things and I come to a situation that yes, I have control, then I will consolidate that particular entity under IND AS 110. Under AS 21, the entire thing was very different because there I was only considering directly or indirectly under subsidiaries or composition of the board of directors. I was not really concerned with power. I was only concerned with the ownership which is there as such. In the Companies Act, there is a subsidiary definition which is there, again, which talks about composition of the board and other things. So one of the main differences which has come under IND AS is, under IND AS, only one entity can have control over the other entity. So you will have to sometime break your head as to decide which entity has control. If there are two entities having say 50% which is owned in a third entity, you will have to decide out of the two which one has control, and that will come as a subsidiary. Otherwise, it will amount to a joint venture. Under AS 21, both companies could have consolidated if you came across this definition which was earlier in AS 21. So under AS 21 and the Companies Act, that more than one entity can have control over the same entity, and hence both will consolidate. Whereas under IND AS 110, only one entity can have control and only that can then consolidate. Everything else will become a non-controlling interest in that sense. Now for control, therefore, three things as we said. One is the power, existing rights that give current ability to direct my relevant activities, and what are relevant activities we'll see likely down the line. And all this is important because all the illustrations will actually try to focus on how do you evaluate all this when I'm trying to assess my control. The second is exposure to or rights to variable returns. So possible variability to positive and negative returns. And do I have the ability to affect my returns using my power? So who makes the decisions, whether I'm doing it as an agent or as a principal or something? So do I have the power to affect my returns? And then I can say I've got some control which is there. What are the rights which we are talking about? We are talking about rights which depends on the nature of activities, could be legal, decision making, structure, voting rights, potential voting rights or contractual rights. All this I will evaluate to decide whether I have got power. I have to decide what are substantive rights or what are just rights on paper. So practical ability to exercise rights, actual capacity to direct the relevant activities. It's not necessary that the rights be actively exercised. Now that is important. If you have a right, you may not exercise it, but if you have that right, it would still mean that you will have the power. And we will see one example down the line on how that substantive rights can change the control situation in a holding subsidiary relationship. When are the substantive rights exercisable? When the decisions about the direction of the relevant activities need to be made. Relevant activities could be your purchase, sales, management of financial assets, decisions over relevant activities, and so on. Now, in a lot of agreements, shareholder agreements, there are also something what is called as protective rights. Now, protective rights normally do not provide power because they are really protective. They are not there to give you any control as such. So normally protective rights are not considered when I am trying to ascertain whether do I have control over the other entity which is there. So these are protective rights which could be there, but which, as we said, is not really going to help me to decide whether I have got control over the other entity. Now, the first or the simplest thing of testing control through power is by my votes. So if I have my more than 50% votes, normally I will say that I have got control. However, I have to consider the rights of minority shareholders. in the old Companies Act, or rather in the Companies Act or the old AS 21, if I have got more than 50%, it automatically gives me control. In Ind AS 110, it does not give me automatically control, because I will also have to consider the rights of minority shareholders. So if the minority shareholders have a right that yes, they can veto some decisions even majority, then I may not be said to have any control there. If I have got less than 50% shareholding, again under the old AS 21 or under Companies Act, it may not be a subsidiary. However, under Ind AS 10, it can still be a subsidiary or with control, because I can have de facto power, which are substantial voting rights or other contractual rights which are there. So under Ind AS 10, shareholding is not the main criteria. It is maybe just one of the starting criteria to decide whether I have got control. It will not become the main criteria which is there. So what are the relevant factors to decide what is control? What is the purpose and design which I have in the whole group which is there? That is important. What are the relevant activities and the process of decision making? Do I have a current ability to direct the relevant activities? Do I have the right to variable returns? And do I have the ability to use power over the investee? I need all of this, or at least some of this, to demonstrate that I can control the other entity, and then I can consider it as a subsidiary. I've got rights, and these are some paragraphs of the standard. If you see that small thing in purple, the para numbers are given there. B15 talks about rights, B18 talks about evidence of practical ability to direct the relevant activities. B19, 20 are some of the indicators which tell you about some special relationship, passive interest, and B51, 52 talks about power in some other cases. Now, these are all really factors which you will have to get into to decide whether you have got control over the other entity, whether it gives you power over the other entity, or the investee, as the standard uses the term. Okay, so how do you really finally decide control? So to determine how investee is controlled, whether by means of equity that gives the holder proportionate voting right, you identify the relevant activities, how decision about relevant activities are made, who has the current ability to direct those activities, and who receives the returns from these activities. In practice, we actually go through this sequencing to decide whether I have got control over the investee. Now, these are some of my relevant activities. We have been using this term in the earlier slides quite often. Now, the relevant activities which are discussed in the standard talks about all these activities which, to determine control, I will have power to decide all these activities which are there. So selling and purchasing goods, managing financial assets, disposing assets, research and developing new products or processes, determining a funding structure or obtaining funds. If I have got a right or a power to decide all or most of these relevant activities, that power will give me control over the entity irrespective of shareholding, and I will really be able to then consolidate and take it as a subsidiary. Okay, now as against subsidiary, you can also have some joint arrangements. Now in a joint arrangement, two or more parties have a joint control. Now that is typically by way of a contractual, and contractual arrangements will give you joint control to the parties to the arrangement. And joint control exists only when decision about relevant activities requires a unanimous consent of the parties that control the arrangement. We saw what are the relevant activities. Most of those activities requires a unanimous consent, then it is joint control. And talk about joint control, it can be of two ways. One is a joint operation and the other is a joint venture. Now, a joint venture typically becomes my associate, whereas a joint operation typically would mean that both the investor companies will consolidate their portion, because then it's a joint arrangement which is there as such, and your principles of Ind AS 111 would then start applying. Typically in practice, if you look at infrastructure companies, you will have such sort of arrangement, infrastructure companies or real estate companies. In a real estate company, you can have one person bringing in the land and the other person doing the entire construction. So it can either become a joint operation or a joint venture, depending on how their contractual arrangement is structured. Similarly, in an infrastructure company, You can have one person lending the name so that the net worth is captured of that person, and the other uh, person who is there bringing in the technology and the funding which is there as such. So again, that would be a joint venture or a joint operation. Typically, such arrangements are not very long term. They could be short term arrangements till the project is over or up to a particular life which is given in the contractual arrangement which is there. Okay. So your joint arrangements can be either a joint operation or a joint venture. In a joint operation, rights to assets and liabilities are common, and you account for those assets liabilities as per the applicable IND AS. I only account for my share. In a I will account it as a joint venture, as an investment, and as per IND AS 28, which is there. And IND AS 28 says, talks about significant influence, so which is really the associate part of it, where that line by line consolidation will not apply, but it will only take the equity pickup which is there. So it's the power to participate in financial and operating decision, but not control or joint control of those policies. So this is how really we first decide as to whether my investee company is a subsidiary, where I look at the control definition as per 110, and there is a lot of literature on 110 which is available throughout the standard, as well as in the ITFG and the education material. Or I will decide whether it becomes my joint through and joint arrangement, either a joint venture or it becomes a joint operation which is there as such. Now with this, it's a simple background to the standard. We can now take up some issues which are there, and these are some typical issues which we have faced in practice. And the question is there, the answer is also there, the discussion is given right there. So I'll read this particular background which is there. So here we are going to discuss about voting rights plus contractual rights. So you have got an entity H which is having 40% of voting rights of entity S, and there are 6 other shareholders who have got 60% voting rights. And you have an agreement among all shareholders which grants equity H the right to appoint, remove, and set the remuneration of the management responsible for directing the relevant activities of entity S. Now with these facts, you have to decide whether entity H have the power over entity S. If you decide H has a power over entity S, even with 40% shareholding, it will become a subsidiary and it will consolidate at 40% also. So the facts are straightforward. My holding in S is 40%, but the other 6 shareholders who are 60% have given me a right to appoint, remove, or set the remuneration of the management who are really doing the day-to-day jobs. Now, if you read that paragraph 40 to 43, the absolute size of my holding is not conclusive in whether I have sufficient right to give me power. However, so 40% doesn't tell me that I have the power. However, with that contractual right which is there with me of setting the relevant activities, what is happening, who are doing it, what are their remuneration, it gives me something more than 40%. And whether H exercises or doesn't exercise that right is not relevant. The fact that there is an agreement which gives it the power also means that H has the power to control entity S. And therefore, entity S would be considered a subsidiary, and entity H would consolidate at a subsidiary. And what will happen is it will consolidate only maybe the entire thing, but 60% will become what is called the non-controlling interest. And this is very typical in practice in a lot of shareholder agreements which are there, where even with 26% shareholding, you still have a right to decide what the management is doing. So normally we just feel that, oh, it's only 26%, it is just associate, we do that equity pickup. It doesn't happen all the time. I have to look at the shareholders agreement to decide what is the power available with entity H in directing the activities of entity S which is there, because that is what really is important from the perspective of IND AS 110. The second is again on the control thing, where again we are talking about voting rights and contractual rights. So we have got AB Limited, which owns 45% of the share of C Limited. there is an agreement with some other shareholders holding 20% that they will always vote in the same manner as AB Limited. For all decisions, a simple majority is required. Now, in this scenario, does AB Limited have control over BC Limited? Now, this is frankly a no-brainer because I own 45% directly. 20% other shareholders have given me the right to decide that they will vote with me whenever I vote on something. So automatically, I am able to direct the relevant activities of the other company. So again, there is a direct paragraph which is reproduced here. So in most of the issues which are there, we are looking at the direct paragraphs, and so that it will guide you as to why we are coming to that conclusion. So you have got this paragraph B39, which states that a contractual arrangement between an investor and other vote holders can give the investor the right to exercise voting rights sufficient to give power to the investor. Now, even if it doesn't have direct rights, a contractual arrangement may ensure that the investor has enough other vote holders on directing the relevant activities. Therefore, in this case, again, EB Limited will consider BC Limited as a subsidiary and will consolidate. So again, we are talking here about voting rights less than 50%, but along with contractual rights, the other entity still becomes my subsidiary. Take the third case on my ability to control the relevant activities. So we have got AB Limited. AB Limited has given a loan to BC Limited, and BC Limited has taken, or loan is taken by BC Limited, and the loan taken by BC Limited is against security of shares of AC Limited, and BC Limited again holds 80% voting shares of AC Limited, and the loan of BC Limited is against shares of AC Limited, the third entity. Now, whether the shares provided as security provide power to AB Limited over AC Limited. I am talking of the first entity and the third entity now. So AB Limited has given a loan to BC Limited. They are not connected in that sense. BC Limited has in turn 80% shareholding, and that shareholding is 80%, and I have taken a loan against security of the same shares. Now, whether AB Limited has power over AC Limited. Now, again, we look at the paragraph of IND AS 10, which states that the investor has power over an investee when the investor has existing rights that give it the current ability to direct the relevant activities which significantly affect the investee's returns. Here, AB Limited does not have the current ability to direct the relevant activities of AC Limited. However, if BC Limited defaults on the said loan, so if BC Limited defaults on the said loan, I will straight control 80% of AC Limited because the loan is again shares of AC Limited. So in that case, AB shall gain majority voting rights in AC Limited, and thus AB shall exercise judgment based on the facts and circumstances, including evaluation of factors, to conclude if AB has the current ability to direct the activities that most significantly affect the returns of AC. Now, if in an evaluation as an auditor or in the company, it is found that BC Limited does not have the capacity to repay the loan or something, then I will look at what is the security for the loan. If I believe that BC Limited is not able to repay the loan, I will obviously encash the security which is available. In that case, then AC Limited automatically I will start controlling because of the 80% shares which are held in AC Limited, which are pledged against the loan of BC Limited. So I have to actually decide here whether I am likely to get ability to direct the relevant activities, and the year in which I decide that I can now direct the activities of AC Limited, because in case BC Limited is going to default on the loan, then it becomes a subsidiary for me in that sense. How much I consolidate, what is non-controlling interest, that's a different thing, that's a calculation thing, but it still can become my subsidiary based on this concept of control which is there. I also need to do a reassessment of control. And here if you see, AB Limited is holding 90% shares of ABC Limited, and BC Limited is holding 85% of shares of ABC Limited. So one is holding equity shares, one is holding preference shares. These are the total number of shares. Now ABC Limited, which is the center company, has not paid dividend on its preference shares for the last 2 years. There is no agreement between anyone. But if a company has not paid preference dividend for 2 years, there is a Companies Act section which comes into play. Second proviso of that section 47 of the Companies Act says that if dividend in the respect of a class of preference shares has not been paid for 2 years or more, such preference shareholders shall have a right to vote on all the resolutions, which means they enjoy equal rights in voting akin to equity shares. Now, in the facts given, ABC Limited has not paid that dividend for 2 years. That proviso of that section will get triggered, and all preference shareholders shall have equal right to vote on all resolutions, including the what is done equity shareholders. Now, if I look that, my whole control assessment changes. So first 2 years, nothing may happen, but in the third year, just because dividend is not paid by ABC Limited, my whole control assessment changes. Now, if I look at Ind AS 110, para 8 requires an investor to reassess whether it controls an investee if facts and circumstances indicate that there are changes to one or more of the three elements of control. Now, because of this non-payment of preference shares, I'm just getting the power immediately, because then I am getting more than 50% thing. So in the present case, upon non-payment of dividend by ABC, BC Limited becomes entitled to 56% of the voting rights, and voting rights of ABC Limited will stand reduced from 90% to 30%. So ABC Limited will then get consolidated with BC Limited, because then I am considering my total shares and not only the preference shares or equity shares separately. So till that year, ABC Limited was a subsidiary of AB Limited. Automatically now, in the year in which the default of preference shares is there, it becomes a subsidiary of BC Limited. So BC Limited will now start consolidating ABC Limited, and AB Limited, even with that 90% equity shares, because my percentage now goes down to 30, because now I am calculating over my total share capital, including the preference shares. It automatically becomes a subsidiary with my shareholding remaining the same as such. So every year this is something which needs to be done, and I really don't know in big groups whether such assessments are really being done, because this will not come as any transaction. It is just a non-payment of preference shares which can become a trigger for reassessment of control, and you have to be very careful about such situations being triggered in a group of companies where it is a fashion nowadays to issue preference shares and not pay the dividend or something. And a lot of people miss out this second proviso of section 42, where automatically the preference shareholders are given rights which are similar to equity shareholders. Issue number 5, again on control. You have got X, Y, and Z who hold 33% each of the voting rights in ABC Limited, along with the right to appoint 2 directors to the board of ABC Limited. Out of those 3 companies, so X, Y hold 1/3 each. So obviously none of them are going to control ABC. They will all be associates in that sense. However, X Limited holds options that are exercisable at a fixed price at any time, and the option is in the money, not out of money, but in the money. And if exercised, would give it all the voting rights in ABC Limited. However, X's management does not intend to exercise the options. So what are the facts? 3 companies are holding 1/3 each in the ABC Limited. So they are all associates in that sense. However, X Limited, the first company, also holds call options which are exercisable at any time, and the option is in the money, so they can exercise anytime. However, the intention of the management is not to exercise the option. Now, your first prima facie reaction is that, okay, in that case, I will ignore the options and I will still continue as an associate. However, if you see that para B14 of Ind AS 110, it states power arises from rights. So if I have got rights, whether I intend to exercise or I do not intend to exercise, my power is still there. So it's something like that, yes, as the head of the family, I have the power to do something, whether I do it or don't do it something, it's still my power which is there. So in that sense, therefore, if you look at the entire discussion in that paragraphs of Ind AS 110, this appear to be substantive rights and they are not protective rights, and therefore X Limited will need to consider ABC Limited as a subsidiary and consolidate, whereas Y and Z would continue considering that as an associate and not consolidate. So again, a very typical situation which arises in 110, again something which is very often there in practice, and again a lot of structuring happens around this by big corporate groups which are there. Issue number 6, having power without majority, size of investor shareholding plus dispersion of other shareholders. Now AB Limited holds 48% shares in Z Limited. Now AB Limited neither controls the composition of the board of Z Limited nor it exercises control more than one half, because it's holding only 48%. So it doesn't qualify as a subsidiary under the Companies Act 2013. However, the fact is that the voting rights in Z Limited other than those held by AB Limited, so that 52% which are held by thousands of shareholders, none of them are holding more than 1% of the voting rights. And none of the shareholders has any arrangement to consult any others or make any collective decisions. So the fact is AB Limited holds 48% in Z Limited. The other shareholders, 52%, are all less than 1%, all scattered all across the country, and no one knows each other, so that they will not be able to come together and exercise that control of 52% jointly. Now, whether AB Limited would consolidate Z Limited? Now, the answer here would be yes. Because in the given case, since it is impracticable for other shareholders to act together and outvote the investor's decision, and there is no such arrangements amongst them, AB Limited will be said to have control over Z Limited, even if it holds less than a majority. Now, this is a typical example where without any contractual arrangement that I can control the board, I can control the management, I can direct the relevant activities, even without all that power, with 48%, I still have control. Just because of the dispersion of my other shareholders. So with 48% in a scenario like this, I will still have the power in that sense. And in which big corporate groups you will have to decide on such things. Say for instance, a lot of managements say that I am controlling that company even with a 30% shareholding. And the reason is because they know that the 70% shareholders who are not likely to come and vote against me and block against my 30% shareholding. So sometimes even with 30% shareholding, 40% shareholding, I may need to consider my other investee company as a subsidiary and not just as an associate for consolidation. Issue number 7, and this is something which query comes all the time from various clients or groups. How do I distinguish between control as per 110 and the Companies Act 2013? Because 110 and Companies Act both require to present CFS. The rules of Companies Act are different. The rules of control of Ind AS 110 are different. Now the answer is given in the rules of the company's accounts rules which are there. And the rules which are there, they say that forms and items contained in financial statements should be in the form specified in Schedule 3 and comply with accounting standards or Ind AS as applicable. It also says, provided that the items contained in financial statements shall be prepared in accordance with definitions and other requirements specified in the accounting standards as the case may be. So when I am deciding what to consolidate, I will look at the definitions which are given in the accounting standards rather than what is given in the Companies Act. Comes to reporting under the annual return for the Companies Act, I may go with the Companies Act definition. But when it comes to preparing consolidated financial statements, the definition under Ind AS will need to be considered. And this is how you will have to reconcile the two definitions of subsidiary or what to consolidate and when to consolidate as per the Companies Act and as per the Ind AS rules which are there as such. Issue number 8 is talking about a casting vote, which also is there in a lot of cases in practice. So you have AB Limited, 50% voting shares in XY Limited, and it nominates 3 directors in XY Limited. Now, 3 other investors nominate 1 director pursuant to a shareholders agreement. So total 6 directors, 3 AB Limited nominates, 3 other directors. Now, all decisions regarding relevant activities of XY Limited are taken by the board of directors by a simple majority. However, as per the articles of association, one of the directors by AB Limited would be the chairman of the board and has a casting vote if there is no majority decision reached. Now, whether that can give AB Limited control over XY Limited. Now, in this case, 50%, which will not give me control because of shareholding, because I do not have the power by way of shares to control. But because of the fact that even my directors are 3 and 3, so no majority of directors. However, I have a veto right. I have a casting vote in case of the voting happening at the board meeting of 3 versus 3. And if you look at that para B40 of Appendix B to IND AS 110, other decision making rights in combination with voting rights can give an investor current ability to direct the relevant activities. And therefore, even with 50% shareholding and the casting vote, which gives me the veto right to take final decisions, AB Limited will have the current ability to direct the relevant activities to control over board decision, and hence it controls XY Limited. Okay. So this really completes that first part on how do I ascertain control which is there. And let us see whether you have got any. Let me just pause at this place and see whether, where is the chat box? I'm just trying to find the chat box. So any questions so far, or do you find this too fast? Yeah, any feedback? So are you all there or not there?
I think it's fine.
So no questions so far?
No, nothing from my side at least.
Okay. Should I wait for 2 minutes to see if any questions are there? Okay, let's move on. I'll start the sharing again, because I want to complete on time. We go on to the next step, which was there in my initial first 2 slides, the process of preparing consolidated financial statements. Now, this is how really the whole process works. If I have got a CFS to be prepared, I have to decide whether it's an entity controlled by parent. So there would be subsidiaries, and then I follow either the IND AS 103 or 110 or AS 21 as per the old standard. If it's a jointly controlled entity, it could be a joint operation or a joint venture. So in a joint operation, I follow 103 or 111. In the old standard, I follow AS 27. If it's a joint venture, I will follow, or if it's an associate, I will follow IND AS 103 or IND AS 28, or in the old standards, I follow AS 23. So in the old standards, primarily you have got 21, 23 and 27. And in the IND AS, you have got 110, 111, IND AS 28. And in case of some business combinations, you also need to follow that IND AS 103 principles which are there as such. So this gives a simple idea of how do I really go about, which standard do I follow, because if I decide what is to be done and I follow a wrong standard, my whole results will be all wrong. And this you can come to only when you can first decide whether you are a subsidiary or you are a jointly controlled entity or you are an associate. Only then you can realize which of the standard to fall into. So maybe some examples on this. So you have got A Limited, where 60% is held by B Limited and 40% is held by C Limited. And there is a contractual arrangement which establishes joint control over A Limited. Now, how will B Limited consolidate A Limited in its CFS, whether as a JV or as a subsidiary? So you have got B Limited which holds 60%, C which holds only 40%. So as such, A becomes the subsidiary of B. but there is a contractual arrangement between B and C, so they will jointly really control A Limited with that 60 and 40% holding. Now, how will I consolidate in CFS? So under IND AS, if contractual arrangement results in joint control, then it is not considered a subsidiary, irrespective of whether I hold 60 or 40%. However, in AS 27, the old standard, they may still allow you to consider it as a subsidiary because of the paragraphs which are reproduced there. Under IND AS 28, B Limited will consolidate A Limited as a JV, which means equity method. However, under AS, B Limited will consolidate A Limited as a subsidiary. So you can see the change in the old standard and the new standard. So once you migrate to IND AS, it is all in substance what is there, what is the control you are having, that will decide how do you consolidate, whether as a subsidiary or as a associate. So in the same example, you will have to really look at the contractual arrangements rather than just the shareholdings which are there. Now, this is the next in this is how do I calculate my non-controlling interest which is there. Now, non-controlling interest again defined very differently under the new standard and the old standard. Under the old standard, it was called minority interest. We call it non-controlling interest under IND AS. NCI or MI as we call it. Now, MI has nothing to do with that series of movies which have come, which we called MI, Mission Impossible. But sometimes people do say that when I do consolidating thoroughly is a mission impossible for a lot of cases. But we are not talking about that MI. We are really talking about minority interest or non-controlling interest. So these are the definitions. Is the equity in subsidiary not attributable to the parent? MI used to call it something differently. I'm not getting into the old thing at all. The measurement NCI is measured as a share of the entity's net assets in the event of liquidation at either fair value or proportionate share, option to decide at each business combination or all other components at fair value. And one major change is NCI can be negative. So in the new standards, when I am calculating non-controlling interest, it can be negative. In the old standards under my 21, 23, 27, minority interest would normally not be negative unless there is a binding obligation on the minority to make good the losses. Now that's a major change from the old consolidation process to the new consolidation process, which is not really again highlighted too much, but that's a major change from the AS series of standards to the IND AS series of standards. And this happens when you have a newly formed subsidiary or associate, and not really an associate, when you have a newly formed subsidiary which is making losses and you have no agreement between the minority shareholders to make good the losses. So under the old standard, I used to take the entire loss to the holding company in consolidation, whereas under IND AS, I will still allot something to the non-controlling shareholders, though they may not have any binding agreement to make good the losses which are there as such. So again, some typical issues on this non-controlling interest. You have Classic Limited acquires 60% shares of Natural Limited for 97.5 crores. The fair value of the identified net assets is 150 crores. Fair value of the 40% shares held by the non-controlling shareholders is 65 crores. Carrying amount of Natural's net asset is 120 crores. So you've got the carrying value 120, the fair value 150. You have got the fair value of the 40% shares, you have got the value of the 60% shares, which is 97.5. So how do I calculate my NCI? I can calculate NCI in two ways. One is I calculate it at fair value, and the other is proportionate share of identifiable net assets. Now, identifiable net assets in both are 150. That goodwill really becomes a balancing figure. The NCI in the first case, I take it at fair value. And in the second case, I take it at 40% of that identifiable assets. Consideration paid remains the same, but you can see that the NCI figure will change depending on which method you need to follow. And obviously, whatever method you follow, you need to follow that consistently. Normally, it is that proportionate share in the identifiable net assets which is followed, because every time you may not be able to measure that at fair value. The second issue on this NCI, you have got S Limited, which has 80% interest in MS Limited and 25% interest in VE Limited. MS Limited in turn holds 30% interest in VE Limited. Now, when I am consolidating, how much will I consolidate and what will become my non-controlling interest? So how much do I hold directly? I hold 80%. So I control MS Limited. Since MS Limited holds also 30% equity, so I again hold 30% equity there. So S holds 25% direct and the related voting power in V Limited. So SL therefore holds 25% plus that 30% through that MS Limited and 25% directly. So therefore I will need to consolidate. So S Limited controls V Limited also, and its entitlement is based on the actual ownership interest. However, thus in the present case, SL Limited share in V Limited is 49%. So I will consolidate based on the shareholding which is there, but how much will I consolidate and how much will be by NCI? My NCI here will become 51% because I really look at the figures. It is 25% plus 80% of 30%, which is 49%, and 51% shall be attributable to NCI. So while deciding whether I have control or not, I will look at the shareholding 55% of V Limited. But when I actually calculate the figures for consolidation, NCI will become 51% in the example given in this case. So my percentages for deciding whether I have control would be different. My percentages to calculate NCI could be different. Again, something which in practice you need to be very careful about. And this will have to be done year after year, because sometimes every year you may have some changes in these percentages which are there between these companies. Next issue which is there, entity A has 80% equity in S, 30% equity in L, and L holds 20% equity in S. In CFS prepared by A Limited, how would NCI of S be considered? So how will I consider the non-controlling interest of S? Here my queries are not on control and other things. This is just on how do I calculate non-controlling interest. So IND AS 110 defines as equity in subsidiary not attributable to a parent. Therefore, when part interest in a subsidiary is held by parents associates, parents should calculate NCI even after considering its indirect holding. So if I am holding 80% directly and if I am holding something indirectly, I will need to consider that, and only the residual will become the non-controlling interest. So what would be the non-controlling interest in this case? It will be 14% because it would be 20% of 70%, and 86% is my holding, 80 direct plus 30 indirect. So the remaining only will become my NCI. So NCI calculation, I not only see the direct holding which is there, I also see my indirect holding, and only the residual then will become what is called my non-controlling interest. And why is that so? Because of the very definition of NCI given in 110, which is different as we have seen earlier from the definition of minority interest in AS 21. So when I look at equity in a subsidiary, I have to look at it not attributable to a subsidiary directly as well as indirectly. And therefore, I calculate both the percentages and then come to the non-controlling interest which is there. Now, look at this example again on NCI. A parent gives an interest-free loan of 100 crores to its subsidiary, in which it holds 80% equity interest. It's not required to be repaid by the subsidiary. It's an interest-free loan to be used for a long period. Now 20% is held by someone else who is a non-controlling shareholder. Now the non-controlling shareholder does not make any matching contribution. Typically when I give 100 crores or when the entity needs 100 crores, I will need to bring in 80 crores and the other party will bring in 20 crores. But here I am just bringing in the entire 100 crores. The other party does not bring in anything. Maybe it doesn't have the funds. Now what is the impact of such loan on the NCI of CFS? Now, an interest-free loan given by a parent are primarily contributions where no financial or non-financial obligation exists. If you look at this para of B96 of 110, it says that when the proportion of equity held by NCI changes, an entity shall adjust the carrying amount of the controlling and NCI to reflect the changes. and it will recognize this directly in equity, any difference between amount paid by which NCI are adjusted and the fair value of consideration paid. Now in this case, though that person is not getting anything, when I am consolidating, when I am calculating my NCI, I will have to allocate 20 crores to the non-controlling interest, mainly because of this paragraph B96 which is there. Because tomorrow if the entity has to say get liquidated, they will equally have to take that liability of 20 crores which is there. So though the parent has given 100 crores, in standalone it will say that 100 crores given to a subsidiary. Whereas when I consolidate that subsidiary, 20 crores out of that will be getting allocated to the non-controlling interest which is there. And that is why there are a lot of groups where in a standalone you may find a different figure of loan given to subsidiaries, whereas when it comes to consolidated, though a lot of things can get knocked off, everything may not get knocked off, because typically you will say that, oh, I have given 100 crores to a subsidiary. When I consolidate, again 100 crores gets eliminated. It may not get eliminated because of this particular provision without any matching contribution having come in. Now 20 crores I may still need to allocate as a non-controlling interest in the consolidated financial statements of the parent. So that is why it is said that doing this consolidations is not something very simple, and you need some good understanding of the standard to really do this consolidation process which is there. It is not automatic, and therefore there is no software which has really come out so far which can help you to do this on an automatic basis. The eliminations are not just knocking off figures. The eliminations are based on an understanding of the standard, and you just cannot just say that in Excel a plus and a minus will just get knocked off or something. What happens in recognizing and measuring goodwill or a gain from a bargain purchase or capital reserve? Now, whenever you 110, automatically 103 also comes in, because if you have a business combination and a consolidation happening, all these concepts are intertwined or interlinked in that sense. Now, this is something which we understand that in India is 103 if fair value of the acquired assets, net assets, is more than the aggregate value of the consideration or NCI or the fair value of earlier interest, it amounts to goodwill. In ES 21, it was a different concept which was followed, but there also there was goodwill. And if goodwill arises, do we impair it or do we test it for, or amortize it, or do we test it for impairment? Earlier, we always used to, in the earlier, we used to say that the standard is silent, and lot of people used to do any amortization as per the old standard which is there. In the new standard, it clearly says that you test it for impairment. And only yesterday, the accounting standard boards has been debating this, that these provisions of 110 and 103 are likely to be amended, where there is a debate going on whether you have to go back to amortization or you would just like to need to do the testing for impairment. The majority view as of now seems to be that you continue testing it for impairment, with some more disclosures coming in as to how the impairment has happened and so on. On the other side, you have got something called purchase, where the fair value of the assets identified is more than the consideration. Then it's a gain on bargain purchase. Under the old standard, we used to call it just capital reserve. In bargain purchase, if there is a clear evidence, I reassess and take everything to OCI and accumulate it as capital reserve. If no clear evidence is there, I just take it directly to equity under capital reserve. So the only difference is, if there is clear evidence, through OCI I take it. If there is no clear evidence, I take it directly through equity. Of course, this is one provision which is a carve out from the IFRS 3, because in IFRS 3, a bargain purchase is taken straight to profit and loss. Whereas in India, the IND AS 103 says you take it either to OCI or directly to equity, depending on what is the evidence which is available. Then the next thing on this consolidation is of this foreign operations. Now again, you have got in IND AS 21, you have just everything in the same standard. They are not really distinguished between integral, non-integral. Whereas under AS 11, you have different provisions for integral and non-integral. And this is again relevant because in consolidating, if you are having foreign operations, how do you really consolidate? So I'm not again going through this basic paragraphs of the standard, but this was just to have a complete overview of the consolidation along with business combination and this foreign exchange, that this is all reproduced here. Now, goodwill or gain on bargain purchase or capital reserve, what happens on acquisition, foreign operation or a subsidiary in consolidation. So whether to transfer each reporting period on acquisition of the operation or subsidiary. Again, different provisions for Ind AS and AS which are there. So you have goodwill and a gain which is taken to capital reserve. And one of the important things which is also there in consolidation is whether you do it line by line or what is called the equity method. The other is the equity method. Line by line means I do everything line by line. I don't do anything else. It's more of an Excel based calculation with eliminations, and I would say informed elimination, not just automatic eliminations. Or do I go with the equity method which is there? And so again, you have got these provisions which are there in the two standards. In Ind AS 110, you prepare CFS using uniform accounting policies, combine line items and cash flows. Now, Ind AS 110 says you even combine like items and cash flows, whereas under AS 21, it was not talking about that directly. And it was saying that consolidate cash flow statements in case of parent presents its own cash flow statements or something. Offset or eliminate carrying amounts of the parent's investment and of the portion of my equity, and calculation of goodwill or bargain purchase as per 103. Under Ind AS 110, when I am doing these eliminations, I also eliminate cash flows. If you look at the old standard, it was not talking about eliminating intergroup cash flows. So here I need to even eliminate intergroup cash flows. Again, something which I don't know whether all entities are doing it. Cash flow statement in practice is something which is left to the auditors. The companies say that no, this is not something which is our job. They leave it to the auditors. And sometimes it's get done only at the last minute, even after the balance sheet is signed. But there are a lot of complex provisions which affect cash flows also, and the FRRB and the Quality Review Board have come up with a lot of I would say discrepancies in the cash flows which have been prepared, whether these eliminations are there, whether the classification is proper. So I would suggest that when you are doing a cash flow statement in consolidated, please follow the standard, because there are some strict rules which you need to follow in that consolidation. Financial statement as far as cash flow is, it's just not a arithmetical addition of cash flows. Then when I am doing this intra-group losses, it may indicate an impairment which requires recognition in the CFS, which was not the case earlier, which was there. I may, the process of elimination itself may give me an indication of impairment, and I will have to do that in my consolidated statements. So to that extent, it is just not line by line, because I have to do some thoughtful things when I do that consolidation. And in income tax also, I have to apply all temporary differences, or Ind AS 12, I apply to all temporary differences which arise from the elimination of profits and losses, whereas earlier it was just the aggregate of tax expense. So earlier it was just the addition. Now I look at my temporary differences at a group level, and then I decide how does Ind AS 12 apply and how does elimination can happen or something. So consolidation is a complex process as compared to the earlier process which we were following. Again, till what extent do I consolidate? So here it says the entity includes income and expense of a subsidiary from the date it gains control until the ceases to control the subsidiary. Here it just talks about from the date parent subsidiary relationship came into existence. Obviously in 110 I am talking about control. So it is possible that contractually I have got control, say on today, which is say 23rd December 20, whereas in by way of shareholding I have got control only on say 5th of January 2021. So I have got 60% shares on 5th January 21, but I have got contractual control say from today. So my consolidation will start from today, whereas in AS 21 it would have started from 5th January 21 or something. Then income and expense of the subsidiary are based on the amount of assets and liabilities recognized in CFS. So depreciation recognized in the consolidated is based on fair value of all related depreciable assets recognized in the CFS. Under the old AS, it was just really line by line, whereas where my income expense are based on the amount of the asset and liability of the individual subsidiary company, just subject to that intra-group elimination. Potential voting rights. Under IND AS 110, there is something called potential voting rights. So these are not current voting rights, but these are potential voting rights. And as we have seen earlier, if I have got that option to exercise voting rights by buying some more shares, I may still need to decide whether I have control or no control. But to decide on potential voting rights is by itself a very complex topic as such. So we are not going to cover this in detail. The time doesn't really allow us to get into this potential voting right illustrations. But just remember, under AS 21, there was no such concept of potential voting rights. But under 110, and for that you may also need to read in 109, there are potential voting rights which may need to be taken into account to decide your control or no control or whatever. On the NCI and the MI provisions, again, there are differences between 110 and AS 21. So entity shall attribute the component of OCI to the owners of the parent. So even the OCI, I need to do that NCI calculation. We already saw that even if it is negative, I have to do it under 110, which I was not doing it under AS 21. And outstanding cumulative preference shares classified as equity held by NCI, we have to compute its share of profits after adjusting dividends and then calculate my NCI, which I may not be doing under the old standard which was there. On the reporting date, you will see some differences again. It says they should be up to the same reporting date unless it is impracticable to do so. And that unless impracticable to do so is interpreted very strictly. And even if you say that it is somehow not practicable to do so, the difference between the two dates is not allowed to be more than 3 months, whereas in the old standard it was allowed to be more than not 6 months. So that difference also has come down. So I can have December and March, but earlier what people were doing March and September, that is not really now possible. On the equity method also, there are some differences which are there. On acquisition, and this is really talking about that associate consolidation or a joint venture consolidation. Earlier it was 23, now it is 28, IND AS 28. On acquisition, difference between cost of the investment of the entity share is considered. So goodwill is to investment, capital reserve is in equity. Subsequently recognize investor share of profit or loss, OCI and equity after date of acquisition, and distributions received from an investee reduce the, so if I get dividends or something, then I reduce it from the investment which is there. Gain between entities, again I recognize only my unrelated investors' interest. On discontinuation of equity method, whatever was earlier recognized in OCI will be on the same basis, it will now be required to be recognized. In interest in the former associate or joint venture is all measured at fair value, and earlier it was, the earlier standard was saying go back to AS 13, which would be at cost. Now some typical issues on this consolidation on this line by line. Intra-group transactions, how do I really eliminate? Now, AB Limited has obtained a term loan from a bank to make further equity investments in BC Limited, its wholly owned subsidiary, which is in need of funds for construction of a qualifying asset. Equity investment made by AB Limited using the proceeds of the borrowing does not qualify as a qualifying asset, hence it expenses out the associated borrowing cost in the standalone financial statements. However, since the proceeds of borrowing made by AB Limited have been provided to BC Limited as an equity investment and not as a loan, BC Limited does not have any associated borrowing cost from its perspective of SFS. So AB Limited gives money to BC Limited as a, AB Limited borrows money from a bank, so the interest will be expensed out. is using it for equity investment in a subsidiary. The subsidiary uses that money for a new project, which is a qualifying asset. The issue therefore is whether do I need to capitalize the interest which is there. In the standalone financial statements of AB Limited, I will not be able to capitalize because I'm only giving equity to my subsidiary. For my subsidiary, there is no question of capitalizing because I'm only using equity funds. I am not borrowing in the subsidiary. What happens if I do consolidation? From a group level, I have borrowed money for a new project. And therefore, at a group level, I have to follow that substance over form and say that as a group level, I have borrowed money from a bank and that I will need to capitalize as part of my qualifying asset using IND AS 23, which is there, using the concept of IND AS 16 and IND AS 23, which is there. So now this is something which is not a line by line consolidation. Though it's a line by line consolidation, I'm still going to use some logic as to what do I do with the interest. So my interest cost, if I accumulate in my standalone financial statements, will be less than what is the interest cost in my consolidated financial statements, because in consolidated, I am able to capitalize some of the interest cost on this particular term loan which I have obtained, which in turn I have given it to my subsidiary as a equity investment. On a similar thing, I'll just give you one more example which is not reproduced here, which I am just able to recollect. You have a holding company and building. The entire building is leased out to its subsidiary, which uses it as an office. Now, for the holding company, since the entire building is leased out to the subsidiary for an office, it will treat it as an investment property. The subsidiary will also consider that as a lease and treat it like a lease taken or something. I may need to apply 116 to it if it's a long-term lease. What happens in consolidation? In consolidation, it is an asset used for my own purpose. So I will actually have to go and take it back to IND AS 16 and take it to my property plant equipment and not to investment property. Now that's another very simple example of an intra-group transaction where I am giving some immovable assets to my subsidiary for use on a rental or maybe on a no cost basis also. So in my standalone, it could be investment property, but when I consolidate, it will have to go back as my property plant equipment, which is there. A similar example, which is there in this case. So it's not just automatic additions. You will have to apply your mind into the substance of the transactions. The second issue here is on uniform accounting policies, because that is one of the conditions which we saw was there in IND AS 110, that I need to follow uniform accounting policies. Again, a question which comes up now and then in practice. You have H Limited, which follows FIFO. There are two subsidiaries of S Limited, which follows weighted average. A very simple example. Now, when I'm doing consolidation, whether I need to follow these different methods or should I need to follow the same method which is there? And if you look at that para 19 and B87 of 110, they say that you have to adopt the same account policies for transactions and events under similar circumstances. So in this case, if you are having similar circumstances, similar products, similar nature of activities, you will have to follow the policy which is followed by H Limited. So S Limited and A Limited will have to recalculate inventory for the purpose of consolidation. In the standalone, they may do the weighted average, but for consolidation, they will have to recalculate their inventory back to first in, first out method. In practice, it is very difficult to prove that the circumstances are not similar, because then I will have to clearly say that what are the different circumstances, and difficulty of accounting package, difficulty of maybe something else, that my don't staff, it's a remote location, I don't have technically qualified, all that doesn't work in when you are trying to apply these accounting standards. Maybe if it is material, you may just be able to get away with it by saying that only all material policies are aligned. Immaterial need not be aligned. Otherwise, you will need to align your accounting policies. But when it comes to accounting policies alignment on depreciation, ITFG recently gave a very interesting observation. And that is, if you have a PQR a subsidiary of MNC Limited. In the SFS under IND AS, PQR adopted straight line method and MNC adopted the WDV method. Now, when I am doing the consolidated of MNC, which method will I follow? Will I follow what is followed in the holding company, or will I keep both policies separate when I am doing this consolidation? And ITFG has explained this and said that the selection of depreciation is an estimate and not an accounting policy. And rightly so, they said that India's 110 says you align all accounting policies. It doesn't say that you realign all accounting estimates. So if PQR Limited, the subsidiary, is able to prove that their accounting estimate by which they follow the SLM basis is an appropriate accounting estimate, and the holding company says that their estimate, which is based on WDV method, is again an appropriate accounting estimate, I don't need to change the policy of depreciation in the consolidation process which is there. So the main thing here is accounting policies need to be aligned, whereas accounting estimates need not be aligned. I am not saying should be aligned. I am saying need not be aligned if you are able to prove the circumstances in the two companies which are there. In practice, we advise almost all groups that please follow the same policy, because if they are working on a SAP platform or a common ERP, having multiple policies will create a lot of complexity, and there are chances that some mistakes may happen in trying to prepare consolidated statements which are there. Now you also have this issue of classification, and this is really a issue on whether I classify something as current or non-current. Now you have A Limited, an Indian company having a foreign subsidiary, B INC. Now A Limited has taken a loan from a foreign bank repayable after 2025, and there are some other facts where the loan is breached, and before the approval of the financial statements, B INC rectified the breach and the bank agreed not to demand repayment. Now, as per IFRS, once your condition of a loan is breached, the entire classification becomes current as per IFRS or IAS 1, which is there. So BINC, which is following IFRS, not following IND AS, will say that the entire loan is a current liability that is based on that IAS 1 presentation of financial statements. Now, when I prepare consolidated financial statements, I will have to reconsider this, because under IND AS 1, there is actually a flexibility or a concession given that if the entity does not classify it as current, if the lender has agreed even after the reporting period, but before the statements are approved, that no payment would be demanded. So as per that IND AS 1 para 74, this loan can still be considered as a non-current. So BINC in its standalone will show it current, but when I consolidate, I will go back and reclassify that as non-current in the consolidated financial statements. It will not impact my standalone financial statements in that sense. Again, on this classification of current, non-current, which reporting period will I take? I am allowed that 3-month leeway which is there. So when I calculate current and non-current, which is a 12-month period, which date shall I consider? Will I consider my subsidiary's date, or will I consider my parent company's date? Now, the standard is very clear on this, that if the subsidiary's financial statements are for different reporting period, it is necessary to review that balance sheet to ensure that items are correctly classified as current or non-current at the end of the group's reporting period. So if I have got my subsidiary which is preparing its accounts, say on 30th June, my year ending is 31st March. When I am taking my 30th, or say this subsidiary is December, whereas I am March. So when I am taking the accounts of December, what will be considered current? I will actually have to judge from the group's reporting period date, not the subsidiary's date which is there as. And this can give rise to a lot of changes in the classification. It doesn't affect your profitability, but it can change your classification, which can affect a lot of ratios which are there. Again, something which a lot of people don't consider, because they just do that line by line addition on consolidation, even if there are different dates which are there in the consolidation entities which are there. One more typical issue which we come across, you have an entity A which has 4 wholly owned subsidiaries, and each subsidiary holds 25% in Z. So I've got 4 wholly owned subsidiaries, and all those 4 subsidiaries hold 25% in another entity, which is Z. How will I consolidate Z into A? I've got 2 ways of doing it. One is the indirect way, where I do it as an associate. So I've got a wholly owned subsidiary which has 25%. So I will pick up 25% on the equity method, and in turn it goes to A. So all the 4 I will pick up, and in turn it goes to A. But there I will only pick up the profitability. I will not really pick up my assets and liabilities. So in this case, I will again consider indirectly what I am holding in that Z. Or I will do it by line basis, though otherwise it tells me that it is less than 50%, and I am allowed to do that equity pickup also. But here in substance, I am holding 100%, so I will entirely do a consolidation on a line by line basis. So the indirect method is not going to reflect all assets and liabilities, and hence the direct method would be the preferred method in consolidating Z with equity A. A question which again comes in practice is, when do I need to consolidate a LLP or a partnership firm? Now, if you look at again the para 2 of 110, it says an entity controls one or more other entities have to present CFS, and under 110, and any entity that is controlled by an investor is its subsidiary, irrespective of whether such an entity is a company or other type of entity such as LLP or a partnership firm. So in this case, whether you are a company or a LLP or a partnership firm, your consolidation will still have to happen. In practice, this is a very difficult, and this applies to a lot of, again, real estate companies and infrastructure companies, where you form LLPs for a limited purpose or a partnership for a limited purpose. If you look at Schedule 3 requirements for LLPs and partnerships, there are some typical requirements of disclosure also. Now, in the standalone, they will be there. In consolidated, those disclosures, all of them may not come in, but you will still need to consolidate all your LLPs or partnerships in the consolidated financial statements. And the disclosures of the partnership shares, the LLP shares, all that may need to be given in the introduction part as to how am I controlling those LLPs or my partnerships which are there. Sometimes it happens that I don't have a direct subsidiary in my LLP, but I have an associate who in turn has a subsidiary which is an LLP. That also will need to be considered on the respective proportionate percentages which are there, which my associate is holding in a LLP or something. If you really want to understand this, look at the group structure of a company like DLF Limited. You can see that in the balance sheet itself, and you will see how complex is a structure where you have multiple subsidiaries, multiple joint ventures, and each one of them in turn is invested in either a LLP or a partnership for different projects or for buying land or whatever. I think more than 100 entities all across spread in different ways. I am sure in some quarters they must be missing out some of those entities in consolidation. Okay, one more issue, and this is again in practice we face one company holding 20% shares in the other company and vice versa. How do you consolidate this? So X is holding 20% in Y, and Y is also holding percent in entity X. How do I consolidate this? In my school days, I know that we were taught something called simultaneous equations, and this is an example where we typically need to use those simultaneous equations. Now, under my old AS 23, I did use simultaneous equations. However, when you come to IND AS 28, you have this paragraph 27, which says that you just take that direct 20% and consolidate. I don't need to get into that simultaneous equations. In any case, all of us have forgotten how do you work this X and Y and how do you get those simultaneous equations. In Excel, of course, there is a formula which can do this, but IND AS 28 does not want you to do that simultaneous equation. So I will straight do 20% of, in X, I will straight take 20% pickup of Y's profits. And in Y, I will straight take 20% pickup of X's profits based on the standalone financial statements. But in practice, I have myself got a lot of queries coming from other professionals as to what do we do in such cases. And I think the last thing is what happens if you dilute your stake or there is a loss of control. And under Ind AS 110, as per that para 23, it's equity transaction, gain or loss is shown in OCI. As per B28, it can be in consolidated statement of profit and loss. Under AS 21, it was a little different. I think there's just one example on this. Yeah. You de-recognize assets and liabilities of the subsidiary at the carrying amount when the control is lost. Carrying amount is this, and you recognize all these things. And just one example on this before we conclude and get on to some questions. You have A Limited, which is actually holding 100% in a subsidiary. It retains 70% control and sells 30% to a non-controlling investor for 500 crores in cash, and some other figures are given. The carrying value of the subsidiary's net assets is 1300 crores, and additionally there is goodwill of 200 crores. So total is 1500 crores. Now, how do I pass the accounting entry for this? And this is something not typical, which is now asked in the CA final exams also, in your financial reporting paper also. So how do you calculate this non-controlling interest when I'm disposing of this 30%? So as per this para 23 of Ind AS 110, changes in ownership interest in a subsidiary that do not result in my losing control are equity transactions. So they do not impact goodwill associated with the subsidiary or my profit and loss. So at the time of sale of 30%, consolidated financial statements include an amount of 1500 of the subsidiary. Therefore, my accounting entry will be like this. I received cash 500 crores. My equity which I sell off is 50 crores, and my NCI is 30% of 1500, which is 450. So nothing comes to my profit. It is just an equity transaction which I take. It's just impacting my NCI. In standalone, you may have a profit, but in consolidated, you will not have a profit. Of course, this is something which even one of our biggest companies in India had to grapple with in the current year 2021. And they have been able to come around the view that initially, if it was not controlled by the other NCI which was there, I may still be able to do a line by line consolidation and not follow this principle. But the standard really talks about this principle only, that in consolidation, nothing goes to profit and loss. Though in standalone, my 30% profit in A Limited will come to profit and loss. But as I said, one of the largest companies in India has taken a stand that it is possible that even on a consolidated, it may be possible to take it to my profit and loss as such. So I think that is the last slide. No, there is one more slide before we close. So this is that second issue on this dilution which is there. So A holds 60% in B, and NCI holders hold 40% share capital, 50,000 shares. Now my carrying amount of goodwill is 20,000, and there is an option by NCI shareholders who bought extra shares. So just because they bought extra shares, my 60% holding automatically comes down to 40%. So my controlling of 60 just comes down to 40. Now, just because someone else has bought shares in that subsidiary, I will have to start passing accounting entries. And that is how I will pass accounting entries on this, on gain on deemed disposal of control. So fair value of 40% interest is 360, net asset de-recognized so much, NCI de-recognized 180, goodwill so much, and there is a gain on deemed disposal. Now, sometimes you may not even understand such an entry needs to be passed in consolidated, because you will not realize someone else is invested in my group or something, or in my subsidiary or something. But if that happens and you lose control, you will have to pass this in, entry on dilution or stake or loss of control which is there. So I think that's a lot of things in consolidation which I thought we can discuss. There are a lot more things. I just tried to put it down very, very briefly, and with some examples which may interest all of you, because I have not taken very complex examples in that sense, but I hope all of you really understood all the examples, because I did run through them quite fast. Right, so any feedback?
Perfect, sir. Perfect, Himanshuji. Sir, one small question, and which is a question which impacts everyone, but few people remember that. If after implementation of Ind AS, a company is acquired, then the goodwill is to be calculated as per Ind AS 103. That is
Correct.
purchase method.
Correct.
But
Not
the
necessarily purchase method. It could be if it is under common control.
common control appendix C will apply.
Yes.
So now the issue is that when the first time goodwill is calculated, then the fair value of the asset and liability is taken. But every year there will be reconciliation aspect because of the fair valuation and the individual standalone balance sheet, which is at the cost.
Yes, that is possible because if you follow the purchase method, the fair value on acquisition will be calculated and the difference will go to goodwill.
Goodwill.
So
But
whenever then you consolidate, then you will obviously have to do that reconciliation.
because on the date of fair valuation, goodwill is calculated, and the asset and liability also has to go on fair value date on the date of acquisition, thereafter addition and deletion. So it
Correct.
becomes a bit cumbersome. बोलते हैं कि माने खिचड़ी भी हो जाता है accounts का कभी-कभी.
But that is where we are there, no?
Thanks a lot, sir. Thanks a lot for the wonderful session, and really both the speakers have like done सोने पे सुहागा, क्योंकि दोनों topic is so tedious, I would say, or so detailed. Practical application can be there that there is no end to it. But within the given time, both have justified the session. And Himanshu ji, we look forward always to you. I remember your session in Calcutta at ACA when we had a joint program also in Calcutta, and then with DTP as well. So friends, I think we had wonderful session. If some comments can be received from others, Nilima ma'am, कुछ बोलना है आपको मैम?
As usual, wonderful session. How are you, Himanshu bhai? Seeing you after so long.
I am fine, Nilima. Not seen all of you for a very long time.
Really long time. Otherwise, maybe once a year we used to meet at least.
Yes.
That doesn't seem to happen at all this year.
Yeah, because the residential program is on virtual mode this time.
Correct.
Yes.
Correct.
We are supposed to meet more on the virtual mode now.
That's right.
Wonderful deliberations by both the speakers.
Thank you.
Any question? Anyone having any question? They can raise their hands. Although we have overshoot by 6 minutes due to the starting delay which we had. Anyone having any question? The speakers were so crystal clear that there is no other question left. Okay, I don't see any question is there from the audience at large, and they all were glued to you, and there were comments coming in between that the session is going on wonderfully and it's very like a plain vanilla detailed discussion with practical approach. I would request Anup Sangai ji to give his comments. He's the president of ACAE. Anup bhaiya. Anup bhaiya, you're not audible. I think you have not joined your audio. Anup bhaiya, you're not audible. Bhaiya, you're not audible. I think there's some difficulty.
Audio.
Yeah, now perfect. Increase your volume.
Is it audible now?
Yeah, it's audible. It's audible. Boliye bhaiya.
Himanshu ji, Kamal ji, they're excellent session. I was glued to the session, entire session. It was an excellent session. After a long time, I have heard Himanshu ji at ACA, and it was indeed a wonderful session. Thanks very much to both the learned speakers.
And we would look forward to both the speakers again for detailed discussion of 3 to 6 hours on the topic given to them. And now I would request Tarun Gupta ji to give a formal vote of thanks to both the speakers. Tarun bhaiya.
Yes, thank you, Vivek. Thank you, President sir. I, on behalf of ACAE Chartered Accountant Study Circle, propose a very hearty vote of thanks to both our learned speakers, CA Kamal Garg ji from Delhi and CA Himanshu Krishnadwala from Mumbai, who have very well taken the topics, financial instruments, various practical aspects, and practical intricacies of consolidation under IND AS so wonderfully and with such detailed presentations. I think the quality of the speakers and the quality of the presentation and deliberation is visible to all of us through so many good comments that we are getting from the chat from our participants. Thank you. It says very good, wonderful session. Thank you, Himanshu Bhai. Nice session. I think all the delegates have liked both the speakers and their deliberations. I once again thank both the speakers, and I also thank all our delegates and participants who have joined us and have been with us for 3 years. Sir, as a small token of appreciation, we since we cannot give physical mementos, but we are giving e-mementos to our participants, to our learned speakers, CA Himanshu Krishnadwala ji and CA Kamal Garg ji. This is for you. I will request all our delegates to please carry this with a big round of applause. Sir, please, you can maybe take color printouts of these mementos, and after getting it framed, put it in your chambers. You can also share it in LinkedIn, WhatsApp, and other media's email. It will also we will also feel happy if you share these mementos with your friends and fellow colleagues. Thank you so much.
Tarun for Himanshu sir. Memento for Himanshu sir.
I am sorry.
This is for Kamal Garg sir. Please share for Himanshu sir.
Oh, sorry. I can see both these mementos on my screen.
No, you need to share one by one.
One by one. Okay.
Anyhow, friends, I would also like to inform that we all are counting for 2020 to go away as soon as possible, and a week is left. In the meantime, this is the memento of Himanshu sir.
Yeah, is it visible now?
Yes, yes.
Oh, okay. I'm so sorry. I can see both these mementos. I thought both are on screen.
Okay. Anyhow, friends, we look forward for more sessions. Just to inform that since March till date, we have organized around 100+ sessions virtually, and first 2 months of lockdown, we kept our members busy because everyone was getting disheartened with COVID and sitting back home after CA final for the first time. So it was a wonderful session today as well, and we had 100+ delegates at one point of time, and we look forward to share the videos which is there on YouTube, so that people get the benefit of both the speakers at ACA till the time exists. Thanks a lot, Himanshu ji. Thanks a lot, Kamal ji. And thank you, Tarun bhaiya, Anup bhaiya. And thanks to all the delegates who have joined in our Zoom session. Thanks a lot. Good night. And looking forward to a great new year 2021 with more of the excitement and saying bye to 2020 as soon as possible. Thanks a lot. I'm ending the meeting over here.
Thanks, Himanshu sir. Thanks, Kamal ji.